Attention all traders, before you begin trading, please take note of the following important warnings. Trading involves a high level of risk. There is no guarantee that you will make a profit or avoid losses. Please ensure that you fully understand the risks involved before you start trading. It is important to have a trading plan and stick to it. Do not let emotions or impulses guide your decisions, as this can lead to hasty and unwise trading decisions. Be aware of the potential impact of news events and market volatility on your trades. Always stay informed and up to date on current events and market conditions. Never trade with money you cannot afford to lose. Trading with funds you need for your basic needs or for other financial obligations can lead to disastrous consequences. Take responsibility for your own trades and decisions. Do not rely on others to make decisions for you or to provide financial advice. Always exercise caution when using leverage or margin trading. These tools can amplify gains, but they can also amplify losses. Finally, remember that trading is a learning process. Do not be discouraged by losses or setbacks. Instead, use them as an opportunity to learn and improve your skills. Thank you for your attention. Enjoy the audiobook. Introduction. This audiobook is an overview of all the subjects that a good trader needs to be familiar with. Trading is the act of buying and selling financial instruments with the aim of making a profit. Financial instruments can include stocks, bonds, options, futures, currencies, and commodities. An overview of trading is given in the first part. How to pick a broker, get started trading, analyze markets, manage risk, and cultivate the proper trading mindset are just a few of the subjects discussed. The second part of the audiobook explains how to forecast price movements by using indicators, previous prices, and patterns. Charting types, support and resistance, trendlines, stochastics, Fibonacci, and channels are just a few of the topics covered. A framework for applying fundamental analysis to study and forecast financial markets is provided in the third section. Central banks, monetary policy, interest rates, inflation, unemployment, geopolitical events, market sentiment, and correlations are just a few of the topics covered. The need to employ risk management strategies in trading is emphasized in the fourth section. The significance of psychology in trading is also highlighted in the last section. Issues covered include, but are not limited to, maintaining discipline, controlling fear and greed, overcoming destructive inclinations, closing down losing positions, and avoiding revenge trading. The knowledge you gain in this area is essential. Trading can be a complex and challenging endeavor, but it can also be rewarding for those who have the knowledge, skills, and discipline to succeed. This audiobook's goal is to mentor traders toward trading success. The content in this audiobook is sufficient for a newbie to get started learning about trading, as well as for more experienced traders to enhance their understanding and cover some topics they may have overlooked. The first section provides an introduction to trading and the different strategies that traders can use to make a profit. It covers various financial instruments that traders can buy and sell, including stocks, bonds, options, futures, and currencies. The document also discusses the different types of trading strategies that traders can use, such as day trading and swing trading. In addition to discussing trading strategies, this section also covers the tools and techniques that traders use to analyze the markets and make trading decisions. This includes technical analysis, which involves using charts and other indicators to identify patterns in market data, as well as fundamental analysis, which involves analyzing economic and financial data to determine the value of a particular asset. Overall, this section provides a comprehensive guide to trading for both individual and institutional investors. It provides valuable information on how to develop successful trading strategies based on one's own goals and risk tolerance. Overview of trading. Trading is the act of buying and selling financial instruments, with the aim of making a profit. Financial instruments can include stocks, bonds, options, futures, currencies, and commodities. Traders can be individuals or institutional investors, and they can trade through various channels such as exchanges, brokers, and electronic trading platforms. There are different types of trading strategies that traders can use, including day trading, buying and selling financial instruments within the same trading day, with the aim of profiting from short-term price movements. Swing trading, holding positions for several days or weeks, with the aim of profiting from medium-term price movements. Position trading, holding positions for months or even years, with the aim of profiting from long-term price movements. Traders use various tools and techniques to analyze the markets and make trading decisions, including technical analysis, fundamental analysis, and quantitative analysis. Trading also involves managing risks, including market risk, credit risk, and operational risk. Traders use risk management techniques such as stop-loss orders, hedging, and diversification to minimize their exposure to these risks. Overall, trading can be a complex and challenging endeavor, but it can also be rewarding for those who have the knowledge, skills, and discipline to succeed. Technical analysis. Technical analysis is a method of analyzing financial markets and securities by examining historical price and volume data to identify patterns and trends. Technical analysts believe that past price and volume data can provide insights into future price movements and can help traders make informed decisions about buying or selling a security. Technical analysts use charts and other graphical representations to visualize price and volume data, and they look for specific patterns and indicators to make trading decisions. Some commonly used technical analysis tools and indicators include moving averages. A moving average is a line that shows the average price of a security over a certain period of time. Traders use moving averages to identify trends and to determine when to buy or sell a security. Relative Strength Index, RSI. The RSI is a momentum indicator that measures the strength of a security's recent price movements. Traders use the RSI to identify overbought or oversold conditions in a security. Bollinger Bands. Bollinger Bands are a set of lines that represent the upper and lower boundaries of a security's typical price range. Traders use Bollinger Bands to identify potential price breakouts or reversals. Fibonacci retracements. Fibonacci retracements are a tool that traders use to identify potential levels of support or resistance based on the Fibonacci sequence. Technical analysis is a popular approach among traders because it can be applied to any security or market and can provide insights into short-term price movements. However, It is important to note that technical analysis is not a perfect predictor of future price movements and should be used in conjunction with other forms of analysis, such as fundamental analysis and risk management techniques. Here is an example of technical analysis using currencies. Suppose you are a currency trader and you want to use technical analysis to determine whether to buy or sell the US dollar, USD, against the Japanese yen, JPY. You start by analyzing the US dollar to Japanese yen currency pair using a combination of technical indicators. Moving average. You start by plotting a simple moving average, SMA, of the US dollar to Japanese yen currency pair over a specific period, say 50 days. You notice that the moving average line is sloping downwards, indicating a bearish trend in the market. Relative Strength Index, RSI. You then add the RSI indicator to your chart, which measures the momentum of the currency pair. The RSI reading is below 50, indicating a bearish momentum in the market. Support and resistance. Next, you identify key support and resistance levels on the chart. You notice that the currency pair has been trading in a range between 106.50 and 109.50 for the past few months, and it is currently near the lower end of the range. Fibonacci retracement. You then apply the Fibonacci retracement tool to the chart to identify potential levels of support and resistance. The retracement levels are calculated based on the Fibonacci sequence, and they can help you identify potential levels where the currency pair might reverse direction. Based on your technical analysis, you might conclude that the US dollar to Japanese yen currency pair is likely to continue its bearish trend in the near term, and you might consider selling the pair. However, you would also want to consider any fundamental factors that could affect the currency pair's movement, such as economic data releases or central bank policy decisions. Fundamental analysis. Fundamental analysis is a method of analyzing financial markets and securities by examining the underlying economic and financial factors that affect their value. Fundamental analysts look at a company's financial statements, management team, industry trends, and macroeconomic factors to determine the intrinsic value of a security. Fundamental analysis typically involves looking at a company's financial statements, such as its income statement, balance sheet, and cash flow statement, to evaluate its financial health and performance. Analysts may also examine key financial ratios, such as price to earnings, P ratio, price to book, PB ratio, and return on equity, ROE, to compare a company's performance to its peers and to identify potential investment opportunities. In addition to analyzing a company's financial performance, fundamental analysts also look at macroeconomic factors that can affect the market as a whole, such as interest rates, inflation, and government policies. They may also consider industry-specific trends and factors, such as changes in consumer behavior or advances in technology. Fundamental analysis can help investors make informed investment decisions by identifying undervalued or overvalued securities based on their intrinsic value. However, it is important to note that fundamental analysis is not a perfect predictor of future price movements and should be used in conjunction with other forms of analysis, such as technical analysis and risk management techniques. Here is an example of fundamental analysis using currencies. Suppose you are a currency trader and you want to analyze the US dollar, USD, against the euro, EUR, using fundamental analysis. Here are some steps you might take. Economic indicators. You start by analyzing the economic indicators that are relevant to the USD and EUR, such as GDP growth, inflation rates, and employment data. You gather data on the latest economic releases from both the US and the Eurozone. Interest rates. You then analyze the interest rates of both currencies. You look at the central bank's interest rate policies and statements to determine if there is any indication of a change in interest rates in the near future. Political factors. You also analyze the geopolitical factors that could affect the value of the currencies, such as trade policies, political instability, and international relations. For example, if there is a trade war between the US and China, it could impact the value of the USD. Market sentiment. Finally, you analyze the market sentiment towards both currencies. You look at news articles and market reports to gauge whether the market is bullish or bearish towards the USD and euro. Based on your fundamental analysis, you might conclude that the USD is likely to strengthen against the euro due to the following reasons. The US GDP growth rate is higher than the Eurozone's growth rate, indicating a stronger economy. The US Federal Reserve is more likely to raise interest rates, making the USD more attractive to investors. The Eurozone is experiencing political instability, with concerns about the rise of populist parties and the impact of Brexit on the EU economy. The market sentiment is bearish towards the euro due to concerns about the Eurozone's economic outlook. Here's another example of fundamental analysis using stocks. Suppose you are a stock investor and you want to analyze a company's stock using fundamental analysis. Here are some steps you might take. Company financial statements. You start by analyzing the company's financial statements, such as its income statement, balance sheet, and cash flow statement. You look for trends in revenue growth, profit margins, and cash flow, and compare these metrics to the industry averages. Valuation metrics. You then analyze various valuation metrics, such as the price to earnings, P ratio, price to sales, PS ratio, and price to book, PB ratio. You compare these metrics to the company's historical averages and to the industry averages to determine whether the stock is overvalued or undervalued. Competitive landscape. You also analyze the company's competitive landscape, looking at its market share, competitive advantages, and potential threats from new competitors or disruptive technologies. Management and governance. You evaluate the company's management team and its governance practices, such as the independence of the board of directors, to determine if the company is being run in the best interests of its shareholders. Based on your fundamental analysis, you might conclude that the stock is undervalued and has strong growth potential due to the following reasons. The company's revenue and earnings have been growing at a faster rate than the industry averages. The stock has a lower P ratio compared to the industry averages, indicating that it may be undervalued. The company has a strong competitive position in its market, with a high market share and a strong brand. The company's management team has a track record of success and is aligned with shareholders' interests. Quantitative analysis. Quantitative analysis is a method of analyzing financial markets and securities using mathematical and statistical models to identify patterns and trends. It involves using quantitative techniques such as statistical analysis, mathematical modeling, and computer algorithms to process large amounts of data, and to make informed trading decisions. Quantitative analysts, also known as quants, typically have strong backgrounds in mathematics, statistics, and computer science. They use mathematical models and computer algorithms to analyze data, and to develop trading strategies that exploit market inefficiencies and anomalies. Quantitative analysis can be used in a variety of ways, such as to develop trading algorithms. Quants use mathematical models and algorithms to develop automated trading systems that can analyze market data in real time, and make trading decisions based on predetermined rules. Identify market trends. Quants use statistical analysis to identify patterns and trends in market data, which can help traders make informed decisions about buying or selling a security. Risk management. Quants use mathematical models to measure and manage risk, such as by calculating the value at risk, VaR, of a portfolio or by developing hedging strategies. Quantitative analysis is particularly useful in analyzing large and complex datasets, and it can help traders make informed decisions based on objective and data-driven analysis. However, it is important to note that quantitative analysis is not a perfect predictor of future price movements and should be used in conjunction with other forms of analysis and risk management techniques. Here's an example of how VaR can be used in quantitative analysis. Suppose you are a risk manager at a financial institution, and you want to calculate the VaR of your investment portfolio using a 99% confidence level over the next day. You have historical data on the returns of the portfolio, and you want to use a parametric VaR approach. Here are the steps you might take to calculate the VaR using the parametric approach. Calculate the mean and standard deviation of the portfolio returns using historical data. Let's say the mean return is 0.05%, and the standard deviation is 1.2%. Determine the Z-score for the 99% confidence level. Using a normal distribution table, you find that the Z-score for a 99% confidence level is 2.33. Calculate the VaR using the formula, VaR equals, portfolio value, x, Z-score, x, standard deviation. Let's say the portfolio value is $10 million. Then the VaR is VaR equals $10 million x 2.33 by 1.2% equals $279,600. This means that there is a 1% chance that the portfolio will lose more than $279,600 in the next day. However, it is important to note that VaR is not a perfect measure of risk and has limitations. It assumes that the portfolio returns follow a normal distribution, which may not always be the case, and it does not capture the potential losses that may occur during extreme market events. Therefore, it is important to use VaR in conjunction with other risk management techniques to ensure that the portfolio is properly diversified and protected against potential losses. Here's an example of a quantitative analysis using currencies. Suppose you are a currency trader and you want to analyze the relationship between two currency pairs, the euro to US dollar and the US dollar to Japanese yen, using a quantitative approach. You have historical data on the exchange rates of the two currency pairs, and you want to use a regression analysis to determine the strength of the relationship between the two pairs. Here are the steps you might take to perform the regression analysis. Collect the historical data on the exchange rates of the two currency pairs over a specific time period, such as a year. Calculate the daily returns for each currency pair by taking the natural logarithm of the ratio of the closing exchange rate to the opening exchange rate. Calculate the correlation coefficient between the two currency pairs. Let's say the correlation coefficient is 0.75, which indicates a strong positive correlation between the two pairs. Perform a regression analysis to determine the linear relationship between the two currency pairs. Let's say the regression analysis yields the following equation. Euro to US dollar equals 0.75 plus 0.5 US dollar to Japanese yen plus epsilon, where epsilon is the error term and represents the part of the exchange rate that cannot be explained by the linear relationship with US dollar to Japanese yen. Use the regression analysis to predict the exchange rate of the euro to US dollar pair based on the exchange rate of the US dollar to Japanese yen pair. For example, if the US dollar to Japanese yen exchange rate is 110, then the predicted euro to US dollar exchange rate would be euro to US dollar equals 0.75 plus 0.5 times 110 equals 55.75. However, it is important to note that this analysis assumes a linear relationship between the two currency pairs, which may not always be the case. Additionally, currency trading involves a high degree of risk and uncertainty, and past performance may not be indicative of future results. Therefore, it is important to use quantitative analysis in conjunction with other methods, such as technical and fundamental analysis, to make informed trading decisions. Market risk. Market risk is the risk of losses in a portfolio or investment due to changes in market conditions, such as changes in interest rates, exchange rates, commodity prices and stock prices. Market risk is also known as systematic risk, as it affects the entire market and cannot be diversified away through portfolio diversification. Market risk can arise from a variety of factors, such as changes in economic conditions, political events, natural disasters, and changes in investor sentiment. For example, if interest rates rise, bond prices may fall, which can lead to losses in a portfolio that contains bonds. Similarly, if there is a sudden change in geopolitical conditions, such as a war or a major policy change, this can cause volatility in the markets and lead to losses in a portfolio. Investors can manage market risk through a variety of risk management techniques, such as diversification. By investing in a variety of securities and asset classes, investors can reduce their exposure to market risk. Hedging. Investors can use derivatives, such as options and futures, to hedge their portfolio against market risk. Stop-loss orders. Investors can use stop-loss orders to automatically sell a security if it falls below a certain price, which can limit potential losses. Overall, market risk is an inherent part of investing, and investors should be aware of the potential risks and take steps to manage their exposure to market risk. Here's an example of market risk. Suppose you are an investor who owns a diversified portfolio of stocks, bonds, and mutual funds. You are concerned about market risk, which is the risk that the value of your portfolio will decline due to overall market conditions, such as a recession, geopolitical events, or changes in interest rates. One way to measure market risk is to use beta, which is a measure of the sensitivity of a security or portfolio's returns to changes in the overall market. A beta of 1 indicates that the security or portfolio moves in line with the market, while a beta greater than 1 indicates that the security or portfolio is more volatile than the market, and a beta less than 1 indicates that the security or portfolio is less volatile than the market. Here's an example of how beta can be used to measure market risk. Suppose your portfolio has a beta of 1.2, and the overall market experiences a decline of 10%. Based on the beta, you can estimate that your portfolio will experience a decline of 12%, which is higher than the market decline. If the market experiences a gain of 10%, your portfolio would be expected to gain 12%, which is also higher than the market gain. This means that your portfolio is more volatile than the overall market, and is therefore exposed to higher market risk. To manage this risk, you might consider diversifying your portfolio further, investing in assets with lower betas, or using other risk management techniques, such as hedging or options strategies. It is important to note that beta is not a perfect measure of market risk, as it only captures the relationship between a security or portfolio and the overall market, and does not account for other sources of risk, such as interest rate risk or credit risk. Therefore, it is important to use beta in conjunction with other risk management techniques to ensure that your portfolio is properly diversified and protected against potential losses. Credit risk. Credit risk refers to the risk that a borrower will default on its financial obligations, such as failing to make payments on a loan or bond. Credit risk can affect both lenders and investors, as it can lead to losses if a borrower defaults on its financial obligations. Credit risk can arise from a variety of factors, such as changes in economic conditions, changes in the borrower's financial position or creditworthiness, and changes in the borrower's industry or market. Credit risk can be managed through a variety of risk management techniques, such as credit analysis. Lenders and investors can perform credit analysis on potential borrowers to assess their creditworthiness, and to evaluate the likelihood of default. Diversification. By investing in a variety of borrowers and industries, lenders and investors can reduce their exposure to credit risk. Collateralization. Lenders can require borrowers to provide collateral, such as real estate or other assets, to secure a loan or bond, which can reduce credit risk. Credit insurance. Lenders and investors can purchase credit insurance to protect against losses in the event of a default. Overall, credit risk is an important consideration for lenders and investors, and they should take steps to manage their exposure to credit risk by using appropriate risk management techniques. Here's an example of credit risk. Suppose you are a lender who is considering extending a loan to a small business. You review the business's financial statements, credit history, and other relevant information, and you determine that there is a risk that the business may not be able to repay the loan in full, on time, or at all. This risk is known as credit risk, which is the risk that a borrower will default on a loan or fail to make payments as agreed. Credit risk can arise from a variety of factors, including a borrower's financial condition, credit history, industry trends, and macroeconomic conditions. To manage credit risk, lenders may use a variety of techniques, such as credit scoring, loan covenants, collateral, and diversification. For example, a lender may use credit scoring to assess a borrower's creditworthiness based on factors such as their credit history, income, debt-to-income ratio, and other financial metrics. The lender may also include loan covenants that require the borrower to maintain certain financial ratios or meet other performance criteria. Collateral can also be used to secure the loan, such as a lien on the borrower's property or other assets. Here's an example of how credit risk can affect a lender. Suppose you extend a loan to a small business with a credit score of 600, which is considered to be a higher risk borrower. The loan has a 5-year term and an interest rate of 8%. After 2 years, the business experiences financial difficulties, and is unable to make payments on the loan. As a result, you may have to write off a portion of the loan as a loss, which could negatively impact your overall profitability and financial condition. To mitigate this risk, you may have required collateral or a personal guarantee from the borrower, or you may have charged a higher interest rate to compensate for the higher credit risk. Additionally, you may have monitored the borrower's financial condition more closely and taken action to address any potential issues before they became a problem. In summary, credit risk is an important consideration for lenders and borrowers alike, and it is essential to carefully assess and manage credit risk to ensure that loans are repaid in full and on time. Operational risk. Operational risk refers to the risk of loss resulting from inadequate or failed internal processes, systems, or human factors, or from external events. Operational risk can arise from a variety of sources, such as fraud, errors, system failures, cyber attacks, natural disasters, or legal and regulatory compliance issues. Operational risk can affect organizations of all sizes and types, and can lead to financial losses, reputational damage, legal liability, and other adverse consequences. Operational risk can be managed through a variety of risk management techniques, such as risk assessment. Organizations can conduct risk assessments to identify and prioritize operational risks and to develop strategies to mitigate or manage those risks. Controls. Organizations can implement internal controls, such as policies, procedures, and automated systems, to manage operational risks. Business continuity planning. Organizations can develop business continuity plans to ensure that they can continue to operate in the event of a disruptive event, such as a natural disaster or a cyber attack. Training and awareness. Organizations can provide training and awareness programs to employees to help them identify and manage operational risks. Overall, operational risk is an important consideration for organizations, and they should take steps to manage their exposure to operational risk by using appropriate risk management techniques. Here's an example of operational risk. Suppose you are a manager at a manufacturing company that produces electronic components. You are responsible for ensuring that the company's production processes are safe, efficient, and compliant with regulations. However, you are concerned about the risk of operational failures that could disrupt production, harm employees, or lead to financial losses. Operational risk is the risk of loss resulting from inadequate or failed internal processes, people, systems, or external events. It can arise from a variety of factors, including errors, fraud, system failures, accidents, natural disasters, and regulatory non-compliance. To manage operational risk, companies may use a variety of techniques, such as risk assessments, process controls, training, monitoring, and contingency planning. For example, a company may conduct regular risk assessments to identify potential sources of operational risk and develop controls to mitigate those risks. The company may also invest in employee training to ensure that staff members are aware of risks and know how to respond to operational failures. Here's an example of how operational risk can affect a company. Suppose a key supplier for your company experiences a natural disaster that disrupts their production operations. As a result, they are unable to deliver the components that your company needs to produce its products. This operational failure can lead to production delays, lost sales, and reputational damage. To mitigate this risk, your company may have contingency plans in place, such as identifying alternative suppliers, maintaining safety stocks of critical components, or diversifying its supply chain. Additionally, your company may have invested in monitoring systems to detect potential operational failures early and take action to prevent or minimize the impact of those failures. In summary, operational risk is an important consideration for companies across all industries, and it is essential to carefully assess and manage operational risk to ensure that operations are safe, efficient, and compliant with regulations. Stop-loss orders. A stop-loss order is a type of order that is placed with a broker to sell a security if it falls to a certain price level. It is designed to limit the potential loss on a position in case the market moves against the investor's position. For example, suppose an investor buys a stock at $50 per share and places a stop-loss order at $45 per share. If the stock falls to $45 per share, the stop-loss order will be triggered, and the broker will automatically sell the stock at the prevailing market price. This helps the investor to limit their losses if the stock continues to fall. Stop-loss orders are commonly used by investors to manage risk and to protect against unexpected market movements. They can be particularly useful for investors who are unable to monitor their positions constantly or who are not able to react quickly to sudden changes in the market. However, it's important to note that stop-loss orders do not guarantee that an investor will be able to sell their position at the desired price. In fast-moving markets, the price at which the stop-loss order is executed may be different from the specified stop-loss price, resulting in losses that are greater than expected. Additionally, stop-loss orders can also be subject to slippage, which occurs when the actual execution price is worse than the stop-loss price due to market volatility and liquidity. Therefore, investors should carefully consider the risks and benefits of using stop-loss orders and use them in conjunction with other risk management techniques. This topic is discussed further later in this ebook. Hedging. Hedging is a risk management strategy that involves taking a position in one market to offset or reduce the risk in another market. The purpose of hedging is to reduce the potential losses that may arise from adverse price movements or other market risks. There are various types of hedging strategies that investors and businesses can use, including futures contracts. Investors can use futures contracts to hedge against potential losses in the underlying asset. For example, a farmer can sell futures contracts to lock in a price for their crops, thereby hedging against price fluctuations. Options contracts. Investors can use options contracts to hedge against potential losses in the underlying asset. For example, an investor can purchase a put option to protect against a decline in the price of a stock. Currency hedging. Businesses that operate in multiple countries can use currency hedging strategies to reduce the risk of currency fluctuations. For example, a company that earns revenue in euros can use currency swaps or forwards to convert those euros into its home currency, reducing the risk of currency fluctuations. Portfolio hedging. Investors can use portfolio hedging strategies to reduce the risk of losses in their overall portfolio. For example, an investor can purchase put options on an index to hedge against potential market downturns. Hedging is a complex strategy that requires careful analysis and planning. It is important to note that hedging does not eliminate risk completely but instead aims to mitigate it. Investors and businesses should carefully consider the costs and benefits of hedging and use it in conjunction with other risk management techniques. As an example of how to use hedging using currencies. Suppose you are a business owner in the United States who imports materials from Europe to manufacture your products. The cost of these materials is denominated in euros, which means that fluctuations in the euro/dollar exchange rate can have a significant impact on your business's profitability. To mitigate this risk, you may decide to use hedging techniques to manage your currency exposure. One hedging technique is to use a forward contract, which is an agreement to buy or sell a currency at a fixed exchange rate at a future date. Here's an example of how a forward contract can be used for hedging. Assume that you need to purchase 100,000 euros in 6 months to pay for your materials. The current spot exchange rate is €1 equals 1.10 US dollars, but you are concerned that the euro may weaken against the dollar in the next 6 months, which would increase the cost of your materials. To hedge this risk, you enter into a 6-month forward contract with a bank to buy 100,000 euros at a fixed exchange rate of €1 equals 1.12 US dollars. This means that in 6 months, regardless of the spot exchange rate, you will be able to purchase 100,000 euros for $112,000. If the euro/dollar exchange rate weakens to €1 equals 1.08 US dollars, you would have paid $108,000 to purchase 100,000 euros in the spot market. However, since you have already entered into a forward contract, you are still able to purchase 100,000 euros for $112,000, which means that you have effectively locked in a lower exchange rate and saved $4,000. On the other hand, if the euro/dollar exchange rate strengthens to €1 equals 1.15 US dollars, you would have paid $115,000 to purchase 100,000 euros in the spot market. However, since you have already entered into a forward contract, you are still able to purchase 100,000 euros for $112,000, which means that you have effectively locked in a higher exchange rate and missed out on potential savings. In summary, using a forward contract is one way to hedge currency risk and manage exposure to fluctuations in exchange rates. By locking in a fixed exchange rate, you can protect your business from potential losses due to unfavorable exchange rate movements. Diversification. Diversification is a risk management strategy that involves investing in a variety of different assets or securities to reduce the overall risk of a portfolio. By diversifying their investments, investors can potentially reduce the impact of losses in any one particular investment or asset class. Diversification can be achieved in a number of ways, such as investing in different stocks, bonds, mutual funds, exchange-traded funds, ETFs, or other asset classes. For example, an investor may choose to invest in a mix of large-cap, mid-cap, and small-cap stocks across different sectors, as well as bonds and other fixed-income securities. The benefits of diversification include risk reduction. Diversification can help reduce the risk of losses in any one particular investment or asset class. Potential for higher returns. Diversification can also potentially lead to higher returns by spreading investments across multiple asset classes. Improved portfolio stability. By investing in a mix of assets, investors can potentially improve the stability of their portfolio and reduce the impact of volatility in any one particular asset class. Diversification is an important strategy for investors of all levels to consider, regardless of their investment goals or risk tolerance. However, it's important to note that diversification does not guarantee against losses and that past performance is not a guarantee of future results. Investors should carefully consider their investment objectives, risks, and costs before diversifying their portfolios. Here's an example of how to use diversification in the stock market. Suppose you are an investor with $100,000 to invest in the stock market. You want to achieve a balanced portfolio that is diversified across different sectors and asset classes to reduce the risk of losses due to any one company or industry experiencing a downturn. Here's an example of how you could use diversification to build a balanced portfolio. Allocate a portion of your portfolio to large cap U.S. stocks. Large cap stocks are companies with a market capitalization greater than $10 billion. These companies tend to be well established and have a track record of stable earnings. You may consider investing in an exchange-traded fund, ETF, that tracks an index of large cap U.S. stocks, such as the S&P 500. Allocate a portion of your portfolio to international stocks. Investing in international stocks can provide exposure to markets outside the United States and help to diversify your portfolio. You may consider investing in an ETF that tracks an index of international stocks, such as the MSCI EAFE index. Allocate a portion of your portfolio to small cap U.S. stocks. Small cap stocks are companies with a market capitalization between $300 million and $2 billion. These companies tend to be more volatile than large cap stocks but also have greater potential for growth. You may consider investing in an ETF that tracks an index of small cap U.S. stocks, such as the Russell 2000. Allocate a portion of your portfolio to bonds. Bonds are debt securities issued by corporations or governments. Investing in bonds can provide a steady stream of income and help to balance the risk of your portfolio. You may consider investing in a bond ETF that tracks an index of investment-grade bonds, such as the iShares Core US Aggregate Bond ETF. Allocate a portion of your portfolio to alternative investments. Alternative investments are investments that do not fit into traditional asset classes such as stocks, bonds, and cash. Examples include real estate investment, trusts, rights, commodities, and hedge funds. You may consider investing in an alternative investment ETF, such as the Invesco Optimum Yield Diversified Commodity Strategy NO-K1 ETF. By diversifying your portfolio across different asset classes and sectors, you can help to reduce the risk of losses due to any one company or industry experiencing a downturn. This approach can also help to provide a more stable return over the long term. Forex. Forex, also known as foreign exchange, is the global decentralized market where currencies are traded. Forex is the largest financial market in the world, with an average daily trading volume of over $6 trillion. Forex trading involves buying one currency and simultaneously selling another currency, with the aim of profiting from fluctuations in exchange rates. For example, an investor may buy euros and sell US dollars, with the expectation that the value of the euro will appreciate relative to the dollar, allowing the investor to sell their euros for more US dollars than they initially invested. Forex trading takes place over the counter, OTC, which means that trades are conducted electronically between traders without a centralized exchange. Instead, trading is facilitated by a network of banks, brokers, and other financial institutions around the world. Forex traders use a variety of strategies and techniques to analyze market conditions and make trading decisions. Some common techniques include technical analysis, which involves analyzing charts and indicators to identify patterns and trends in price movements, and fundamental analysis, which involves analyzing economic and geopolitical factors that can impact exchange rates. Forex trading carries a high degree of risk, and investors should carefully consider their investment objectives, risks, and costs before investing. It's important to have a solid understanding of the market and the strategies and techniques used in Forex trading before getting started. Here is an example of a Forex trade. Let's say you are interested in trading the euro to US dollar currency pair, and you believe that the euro will strengthen against the US dollar. You decide to buy 10,000 euros at the current exchange rate of US $1.2000/year, which means you will pay $12,000 for the euros. A few hours later, the exchange rate has moved in your favor, and the euro to US dollar rate is now used $1.2100/year. You decide to close your trade and sell the 10,000 euros back into US dollars. At the new exchange rate, your euros are now worth $12,100, which means you have made a profit of $100 on the trade. However, forex trading involves leverage, which means that you can control a large amount of currency with a relatively small investment. For example, if your broker offers a leverage of 100 to 1, you would only need to put up $120 to buy 10,000 euros worth $12,000. This allows you to potentially make larger profits, but it also increases the risk of losses. In addition, forex trading involves bid and ask prices, which are the prices at which you can buy and sell currencies. The bid price is the price at which you can sell a currency, and the ask price is the price at which you can buy a currency. The difference between the bid and ask price is known as the spread, and this represents the profit that the broker makes on the trade. So in the example above, if the bid/ask spread is 1.2001.2002, you would buy euros at 1.2002 and sell them back at 1.2100, which means you would need the exchange rate to move at least 2 pips in your favor just to break even on the trade. It's important to note that forex trading involves a high degree of risk, and traders should carefully consider their trading strategy, risk management, and leverage before entering into any trades. Stock market. The stock market is a public market where stocks, also known as equities, are bought and sold by investors. Stocks represent ownership in a company, and buying shares of a company's stock allows investors to participate in the company's financial success. The stock market is typically divided into 2 main segments, primary market and secondary market. The primary market is where new securities are issued to the public, usually through an initial public offering, IPO. The secondary market is where previously issued securities are traded among investors, and this is what most people refer to when they talk about the stock market. The stock market is often seen as a barometer of the overall health of the economy, as stock prices can be impacted by a variety of economic factors, including interest rates, inflation, and corporate earnings. As a result, the stock market is closely watched by investors, policymakers, and economists. The stock market can provide investors with a variety of opportunities, including potential long-term growth and the ability to earn income through dividends. However, it also carries risks, and investors should carefully consider their investment objectives, risks, and costs before investing. It's important to have a solid understanding of the market and the strategies and techniques used in stock investing before getting started. Here's an example of a stock trade. Let's say you have been following the stock of a company called XYZ, and you believe that the company is undervalued and has good growth potential. You decide to buy 100 shares of XYZ stock at the current market price of $50 per share, which means you will pay $5,000 for the shares. A few days later, the stock price has risen to $55 per share, and you decide to sell your shares to take a profit. At the new market price, your 100 shares are now worth $5,500, which means you have made a profit of $500 on the trade. However, stock trading also involves risks, such as the risk of the stock price going down instead of up. In addition, stock prices can be affected by various factors, such as company news, economic indicators, and geopolitical events. Therefore, traders need to carefully analyze the company's financials, industry trends, and other relevant information before making any trading decisions. Stock trading also involves brokerage fees and commissions, which can affect the profitability of the trade. For example, if your broker charges a $10 commission per trade, you would need the stock price to rise by at least 10 cents per share just to break even on the trade. Overall, stock trading can be a lucrative investment strategy, but it requires careful analysis, risk management, and a solid trading plan. Traders should also be aware of the risks involved and be prepared to adapt to changing market conditions. Bond market. The bond market, also known as the fixed income market, is a public market where bonds are bought and sold by investors. A bond is a debt security that represents a loan made by an investor to a borrower, typically a government or corporation. When an investor buys a bond, they are essentially lending money to the bond issuer in exchange for regular interest payments and the eventual return of the principal investment at a specified future date. The interest rate paid on a bond is known as the yield, and it is typically determined by market conditions, including the prevailing interest rates, and the creditworthiness of the issuer. The bond market is typically divided into two main segments, the primary market, and the secondary market. The primary market is where new bonds are issued to the public, usually through an initial public offering, IPO. The secondary market is where previously issued bonds are traded among investors. The bond market is often seen as a barometer of the overall health of the economy, as bond prices can be impacted by a variety of economic factors, including interest rates, inflation, and creditworthiness of the issuer. As a result, the bond market is closely watched by investors, policymakers, and economists. The bond market can provide investors with a variety of opportunities, including potential income through regular interest payments and potentially lower volatility compared to the stock market. However, it also carries risks, and investors should carefully consider their investment objectives, risks, and costs before investing. It's important to have a solid understanding of the market and the strategies and techniques used in bond investing before getting started. Here's an example of a bond trade. Let's say you are interested in investing in bonds, and you have identified a bond issued by a company called ABC. The bond has a face value of $10,000, a coupon rate of 5%, and a maturity date of 10 years. You believe that the bond is undervalued and that the company has a strong credit rating, so you decide to buy the bond at a discount. After researching the bond market, you find a seller who is willing to sell the bond to you for $9,500. A few years later, the bond market has improved, and similar bonds are now trading at a premium. You decide to sell your bond to take a profit. At the current market price, the bond is worth $11,000, which means you have made a profit of $1,500 on the trade. However, bond trading also involves risks, such as the risk of the bond issuer defaulting on its payments. In addition, bond prices can be affected by various factors, such as interest rates, inflation, and market sentiment. Therefore, traders need to carefully analyze the bond's credit rating, maturity, and other relevant information before making any trading decisions. Bond trading also involves brokerage fees and commissions, which can affect the profitability of the trade. For example, if your broker charges a 1% commission on bond trades, you would need the bond price to rise by at least 1% just to break even on the trade. Overall, Bond trading can be a profitable investment strategy, but it requires careful analysis, risk management, and a solid trading plan. Traders should also be aware of the risks involved and be prepared to adapt to changing market conditions. Futures market. The futures market is a public market where futures contracts are bought and sold by investors. Futures contracts are agreements between two parties to buy or sell an asset, such as a commodity, currency, or financial instrument, at a specified future date and price. In the futures market, investors can trade both physically delivered futures contracts, where the underlying asset is delivered to the buyer at the end of the contract, and cash-settled futures contracts, where the difference between the initial contract price and the final market price is settled in cash. The futures market is often used by businesses and investors to manage their risk and hedge against price fluctuations. For example, a farmer may use futures contracts to lock in the price of their crops ahead of the harvest, while an investor may use futures contracts to hedge against potential losses in their portfolio. The futures market is typically divided into two main segments, the commodities market and the financial futures market. The commodities market includes contracts for agricultural products, energy, metals, and other physical commodities. The financial futures market includes contracts for currencies, interest rates, and stock market indices. The futures market can provide investors with a variety of opportunities, including potential profits from price movements and the ability to manage risk. However, it also carries risks, and investors should carefully consider their investment objectives, risks, and costs before investing. It's important to have a solid understanding of the market and the strategies and techniques used in futures trading before getting started. Here's an example of a futures trade. Let's say you are interested in trading crude oil futures. You believe that the price of crude oil will increase in the coming months due to geopolitical tensions and increased demand from emerging markets. You decide to buy a futures contract for crude oil with a delivery date in 3 months. Each futures contract for crude oil represents 1,000 barrels of crude oil, and the current market price is $60 per barrel. Therefore, you would need to put up an initial margin of $6,000, 10% of the contract value, to buy one futures contract. A few weeks later, the price of crude oil has indeed increased to $65 per barrel, and you decide to close your trade and sell the futures contract. At the new market price, the futures contract is now worth $65,000, which means you have made a profit of $5,000 on the trade. However, futures trading involves leverage, which means that you can control a large amount of the underlying commodity with a relatively small investment. For example, if your broker offers a leverage of 20-to-1, you would only need to put up $300 to control a futures contract worth $6,000. This allows you to potentially make larger profits, but it also increases the risk of losses. In addition, futures trading involves daily settlement, which means that you need to settle your gains or losses every day based on the current market price. If the price of crude oil had instead decreased to $55 per barrel, you would have incurred a loss of $5,000 on the trade, which would have been deducted from your margin account. Overall, futures trading can be a profitable investment strategy, but it requires careful analysis, risk management, and a solid trading plan. Traders should also be aware of the risks involved and be prepared to adapt to changing market conditions. Options market. The options market is a public market where options contracts are bought and sold by investors. Options are contracts that give the buyer the right, but not the obligation, to buy or sell an underlying asset, such as a stock, commodity, or currency, at a specified price and time. There are two types of options: call options and put options. A call option gives the buyer the right to buy the underlying asset at a specified price, while a put option gives the buyer the right to sell the underlying asset at a specified price. In the options market, investors can trade both exchange-traded options, which are standardized contracts listed on an exchange, and over-the-counter, OTC, options, which are customized contracts negotiated between two parties. The options market is often used by investors to manage risk and speculate on price movements. For example, an investor who owns a stock may buy a put option as insurance against a potential price decline, while an investor who is bullish on a stock may buy a call option to profit from a potential price increase. The options market can provide investors with a variety of opportunities, including potential profits from price movements and the ability to manage risk. However, it also carries risks, and investors should carefully consider their investment objectives, risks, and costs before investing. It's important to have a solid understanding of the market and the strategies and techniques used in options trading before getting started. Here's an example on options trade. Let's say you are interested in trading options on the stock of a company called XYZ. You believe that the stock price will increase in the coming months due to strong earnings reports and positive market sentiment. You decide to buy a call option on XYZ stock with a strike price of $100 and an expiration date in 3 months. Each call option represents 100 shares of XYZ stock, and the current market price of the option is $5. Therefore, you would need to pay a premium of $500, 100 shares x $5, to buy one call option. A few weeks later, the stock price has indeed increased to $110 per share, and you decide to exercise your option and buy 100 shares of XYZ stock at the strike price of $100 per share. At the new market price, the 100 shares of stock are now worth $11,000, which means you have made a profit of $5,500 on the trade, the difference between the stock price and the strike price, minus the premium paid for the option. However, options trading also involves risks, such as the risk of the stock price not moving in the expected direction, the risk of the option expiring worthless, and the risk of losing the premium paid for the option. Therefore, traders need to carefully analyze the stock's fundamentals, technical indicators, and other relevant information before making any trading decisions. Options trading also involves various strategies, such as buying or selling call or put options, and combining options with stocks or other options to create complex positions. Each strategy has its own risks and rewards, and traders should choose the strategy that best suits their trading goals and risk tolerance. Overall, options trading can be a profitable investment strategy, but it requires careful analysis, risk management, and a solid trading plan. Traders should also be aware of the risks involved and be prepared to adapt to changing market conditions. Cryptocurrency market. The cryptocurrency market is a decentralized public market where cryptocurrencies are bought and sold by investors. Cryptocurrencies are digital assets that use encryption techniques to secure their transactions and control the creation of new units. The most well-known cryptocurrency is Bitcoin, but there are now thousands of other cryptocurrencies available for trading on various exchanges. The cryptocurrency market is unique in that it is not regulated by a central authority, and transactions are processed through a decentralized network of computers using blockchain technology. This allows for fast and low-cost transactions without the need for intermediaries like banks or payment processors. The cryptocurrency market is often seen as a new and innovative asset class, with potential benefits like privacy, security, and the ability to bypass traditional financial systems. However, it is also known for its high volatility, and there is a risk of fraud and hacking. Investors in the cryptocurrency market can trade cryptocurrencies directly or use derivative products like futures contracts or options to speculate on price movements. It's important to note that cryptocurrency trading can be complex and risky, and investors should carefully consider their investment objectives, risks, and costs before getting started. Here's an example of a crypto trade. Let's say you are interested in trading Bitcoin, one of the most popular cryptocurrencies. You believe that the price of Bitcoin will increase in the coming weeks due to growing demand from institutional investors and increased mainstream adoption. You decide to buy one Bitcoin at the current market price of $50,000. A few days later, the price of Bitcoin has indeed increased to $55,000, and you decide to close your trade and sell your Bitcoin. At the new market price, your Bitcoin is now worth $55,000, which means you have made a profit of $5,000 on the trade. However, crypto trading also involves risks, such as the risk of market volatility, the risk of hacking or fraud, and the risk of regulatory changes. Therefore, traders need to carefully analyze the crypto's fundamentals, technical indicators, and other relevant information before making any trading decisions. Crypto trading also involves various strategies, such as buying or selling different cryptocurrencies, and using leverage to amplify gains or losses. Each strategy has its own risks and rewards, and traders should choose the strategy that best suits their trading goals and risk tolerance. Overall, crypto trading can be a profitable investment strategy, but it requires careful analysis, risk management, and a solid trading plan. Traders should also be aware of the risks involved and be prepared to adapt to changing market conditions. Brokers. A broker is a person or company that acts as an intermediary between buyers and sellers in a financial market. Brokers facilitate transactions by providing access to the market and executing trades on behalf of their clients. In the stock market, brokers can be either full service or discount. Full service brokers offer a range of services, including investment advice, research, and portfolio management. They typically charge higher fees for their services. Discount brokers, on the other hand, offer a more basic set of services and charge lower fees. In addition to the stock market, brokers can also be found in other financial markets, such as the forex market, options market, futures market, and cryptocurrency market. Brokers may also specialize in a particular type of trading or financial instrument, such as day trading or bonds. When working with a broker, investors should carefully consider their investment objectives, risks, and costs. It's important to choose a reputable broker who is properly licensed and regulated, and who has a track record of providing quality services to their clients. Choosing a good broker can be a critical decision that can significantly impact your success in the financial markets. Here are some factors to consider when selecting a broker. Reputation and regulation. Choose a broker that has a good reputation in the industry, and is well regulated by a reputable financial authority. Check the broker's website for regulatory information and look for reviews and testimonials from other traders. Trading platform. The trading platform is the software that you will use to execute trades, analyze charts and monitor your positions. Make sure the broker provides a reliable and user-friendly trading platform that suits your trading style. Fees and commissions. Brokers earn their income by charging fees and commissions for each trade you make. Look for a broker with competitive fees and commissions that align with your trading budget. Assets offered. Choose a broker that offers a wide range of assets that you are interested in trading, such as stocks, forex, cryptocurrencies, or commodities. Customer service. Ensure the broker has good customer support, including a responsive help desk, online resources, and support channels. Security. Verify that the broker has secure protocols and encryption methods to protect your funds, personal information, and trading activities. Educational resources. Look for brokers that provide educational resources, including webinars, courses, tutorials, and trading tools. These resources can help you improve your trading skills and knowledge. Overall, choosing a good broker involves careful research and analysis of your trading needs and preferences. Don't rush into making a decision, and take the time to compare different brokers and assess their features and services. Leverage. Financial leverage is the use of borrowed money to increase the potential return of an investment. When an investor uses financial leverage, they are using debt to increase their purchasing power, allowing them to invest in assets that they may not be able to afford outright. In finance, leverage is often expressed as a ratio between debt and equity. For example, a company with $1 million in assets and $500,000 in debt and $500,000 in equity has a debt-to-equity ratio of 1:1. Leverage can be a double-edged sword, as it magnifies both potential profits and losses. If the investment performs well, the investor can earn a higher return than they would have without leverage. However, if the investment performs poorly, the investor may lose more than they would have without leverage. One common form of financial leverage is margin trading, where investors borrow money from a broker to buy securities. Margin trading allows investors to increase their exposure to a particular stock or market, but it also carries additional risks, such as the risk of a margin call. Financial leverage can be a useful tool for investors, but it is important to use it wisely and understand the risks involved. Investors should carefully consider their investment objectives, risks, and costs before using financial leverage in their portfolio. Here's an example of how leverage can negatively impact a trader. Let's say a trader decides to use leverage in their forex trading account and takes a long position on euro to US dollar. The trader uses 50-to-1 leverage, meaning for every $1 in their trading account, they can control $50 in the forex market. The trader has $1,000 in their account and uses leverage to open a position of $50,000 in euro to US dollar. Unfortunately, the trade goes against the trader's prediction, and the euro to US dollar exchange rate drops by 2%, resulting in a loss of $1,000. The trader's account balance is now zero, and their trade is automatically closed out by the broker due to margin call, a demand for additional funds to cover losses. In this scenario, the trader lost their entire account balance due to the high leverage used in the trade. If the trader had used less leverage, such as 10-to-1, their position size would have been only $10,000 instead of $50,000, and the loss would have been only $200, leaving the trader with $800 in their account balance. This example illustrates how leverage can magnify both gains and losses in trading. While leverage can help traders achieve higher profits, it also increases the risk of losing more than the initial investment. Therefore, it's important for traders to use leverage responsibly, and to manage their risk by setting stop-loss orders and position sizing appropriately. Here is another example of leverage. Leverage is commonly used in the futures market, where traders can control large amounts of assets with a relatively small amount of capital. Here's an example. Let's say that a trader wants to buy one contract of crude oil futures, which represents 1,000 barrels of oil. The current price of crude oil futures is $60 per barrel, so the total value of one contract is $60,000, 1,000 barrels x $60 per barrel. However, the trader only has $6,000 of available capital to invest. With leverage, the trader can borrow the remaining $54,000 from the broker, allowing them to control the entire contract of crude oil futures. If the price of crude oil futures rises to $61 per barrel, the value of the contract will increase to $61,000, and the trader's profit will be $1,000, the difference between the buy price of $60,000 and the sell price of $61,000. However, leverage works both ways, and if the price of crude oil futures falls to $59 per barrel, the value of the contract will decrease to $59,000, and the trader will lose $1,000. Therefore, leverage can amplify both profits and losses, and traders must use caution when trading futures with leverage. It's essential to manage risk carefully and use appropriate risk management strategies, such as stop-loss orders, to limit potential losses. Trading strategies. There are many different trading strategies that investors use to try to achieve their investment goals. Here are some of the most common types. Trend following. This strategy involves analyzing the past price movements of a security to identify trends, and then buying or selling based on whether the trend is up or down. Momentum trading. Similar to trend following, momentum trading involves buying securities that are rising in price and selling those that are falling, with the idea that the trend will continue. Value investing. This strategy involves looking for securities that are undervalued by the market, based on factors like the company's financial performance or its assets. Growth investing. Growth investing involves buying securities in companies with strong potential for future growth, even if the company's current earnings may not be high. Contrarian investing. This strategy involves going against the current market sentiment, buying securities that are out of favor or selling those that are popular. Day trading. Day traders buy and sell securities within a single trading day, with the goal of making small profits on many trades. Position trading. Position traders hold securities for a longer period of time, often weeks or months, and may use fundamental or technical analysis to make their decisions. Options trading. Options traders use options contracts to buy or sell securities at a specific price or time, with the goal of profiting from the difference between the contract price and the market price. Algorithmic trading. Algorithmic trading involves using computer programs to execute trades automatically based on predefined rules. These are just a few examples of the many different trading strategies that investors can use. The most successful traders often use a combination of strategies, based on their own goals and risk tolerance. Risk management. Risk management in trading refers to the process of identifying, assessing, and mitigating potential risks associated with trading activities. The goal of risk management is to reduce the impact of potential losses and increase the likelihood of achieving trading objectives. There are several steps involved in risk management in trading, including identifying and analyzing risks. This involves assessing the potential risks associated with a trading strategy, including market risk, credit risk, operational risk, and other types of risk that could impact the portfolio. Setting risk limits. Once the risks have been identified and analyzed, traders set limits on how much risk they are willing to take on for each trade or overall portfolio. Implementing risk controls. Traders use a variety of tools and techniques to manage risk, including stop-loss orders, hedging strategies, and diversification. Monitoring and adjusting risk. Traders regularly review their portfolio and adjust their risk management strategies as needed, based on changes in the market, the economy, or other factors that may impact the portfolio. Effective risk management is critical for traders to be successful over the long term. By managing risk carefully, traders can reduce the impact of potential losses and increase their chances of achieving their trading objectives. Psychology of trading. Trading psychology refers to the emotional and mental state of a trader while engaging in trading activities. It is the study of how human emotions and behaviors affect the decision-making process in trading, and how to manage those emotions to make more rational and profitable decisions. Trading psychology is important because emotions can have a significant impact on trading performance. For example, fear and greed can lead to impulsive decision-making, causing traders to take on too much risk or exit positions too early. On the other hand, overconfidence can lead traders to take on too much risk, leading to losses. Managing trading psychology involves several key factors, including developing a trading plan. Having a well-defined trading plan can help traders avoid making impulsive decisions based on emotions. Setting realistic expectations. It is important to have realistic expectations for trading performance and to avoid getting caught up in short-term wins or losses. Practicing discipline. Maintaining discipline in following a trading plan and sticking to risk management strategies can help reduce emotional reactions to market movements. Practicing self-awareness. Traders should be aware of their own emotions and behaviors and take steps to manage them when they start to affect trading decisions. Seeking support. Traders can benefit from having a support system of other traders or professionals to help manage emotional reactions to market movements. Overall, trading psychology is a critical aspect of successful trading. By managing emotions and behaviors, traders can make more rational and profitable decisions and achieve their trading objectives over the long term. Why traders fail. There are many reasons why traders may fail, but here are 10 common reasons. Lack of discipline. Traders who do not have the discipline to stick to their trading plan, risk management strategies, or stop-loss orders can suffer significant losses. Overtrading. Traders who make too many trades or take on too much risk can deplete their trading account quickly. Emotional trading. Traders who let emotions, such as fear or greed, influence their trading decisions can make irrational choices and suffer significant losses. Failure to adapt to changing market conditions. Traders who do not adjust their strategies or risk management techniques based on changing market conditions may miss out on profitable opportunities or suffer losses. Lack of knowledge and experience. Traders who do not have a strong understanding of trading strategies, market mechanics, or technical analysis may struggle to make profitable trades. Poor risk management. Traders who do not manage their risk effectively, such as not using stop-loss orders or taking on too much leverage, may suffer significant losses. Lack of patience. Traders who are not patient and rush into trades may miss out on profitable opportunities or take on too much risk. Poor money management. Traders who do not manage their money effectively, such as risking too much on a single trade or not diversifying their portfolio, may suffer significant losses. Inability to control emotions. Traders who cannot control their emotions, such as anger or frustration, may make irrational trading decisions and suffer losses. Unrealistic expectations. Traders who have unrealistic expectations for their trading performance or expect to make quick profits without adequate preparation may be disappointed and suffer losses. Successful trading requires a combination of knowledge, discipline, and effective risk management. By avoiding these common pitfalls, traders can increase their chances of success over the long term. There have been several studies conducted on the failure rate of traders. Here are a few statistics. A study by French and Pataba found that between 1991 and 1996, the average before-tax return of individual investors in the U.S. stock market was 17.9%, while the return of the market was 18.2%. This suggests that the majority of individual investors underperformed the market. A study by Barber and Odeon found that between 1991 and 1996, the average before-tax return of active traders in the U.S. stock market was 11.4%, while the return of the market was 17.9%. This suggests that the majority of active traders underperformed the market. A study by Brad M. Barber and Terence Odeon found that the more actively traders traded, the worse their performance tended to be. The researchers found that traders who made more than 10 trades a month underperformed the market by an average of 0.96% per month, while those who made fewer than 10 trades a month underperformed the market by an average of 0.69% per month. According to a study by the University of California, only about 1% of day traders consistently earn money in the market. These statistics suggest that the failure rate for traders is relatively high, and that most traders tend to underperform the market over the long run. However, it's important to note that there are successful traders out there, and that individual performance can vary widely based on a variety of factors, including skill level, experience, and market conditions. Great known traders and books. Here are some examples of great known traders. George Soros. Soros is a legendary investor and trader who is known for his successful currency trades, particularly his shorting of the British pound in 1992, which netted him a profit of over $1 billion. Paul Tudor Jones. Jones is a hedge fund manager and trader who has been active in the markets for over 40 years. He is known for his macro trading approach and his successful trades in various markets, including stocks, currencies, and commodities. Ray Dalio. Dalio is the founder of Bridgewater Associates, one of the world's largest hedge funds. He is known for his macroeconomic analysis, and his approach to risk management, which he outlines in his book Principles. Jesse Livermore. Livermore was a trader who made and lost several fortunes during his lifetime. He is known for his book Reminiscences of a Stock Operator, which is considered a classic among traders and investors. John Paulson. Paulson is a hedge fund manager who made a fortune betting against the housing market in the mid-2000s. His firm, Paulson and Company, also made successful trades in various other markets, including gold and healthcare stocks. Stanley Druckenmiller. Druckenmiller is a former hedge fund manager who worked for George Soros at Quantum Fund. He is known for his successful trades in various markets, including currencies, commodities, and stocks. Stephen Cohen. Cohen is a hedge fund manager who founded SAC Capital Advisors, which was later renamed Point72 Asset Management. He is known for his successful trades in various markets, including stocks, currencies, and commodities. These traders are just a few examples of the many successful traders who have made their mark in the markets. It's important to note that while these traders have achieved great success, trading involves risk and there is no guarantee of profits. Here are 10 popular books that are frequently recommended for traders. Reminiscences of a Stock Operator by Edwin Lefebvre. This classic book is a fictionalized biography of Jesse Livermore, a legendary trader from the early 20th century. It provides insights into the psychology of trading and the importance of risk management. Market Wizards by Jack D. Schwager. This book is a collection of interviews with some of the most successful traders of the 20th century. It provides insights into their strategies, techniques, and mindset. The Intelligent Investor by Benjamin Graham. This book is considered a classic of value investing and provides a framework for analyzing stocks and making informed investment decisions. Technical Analysis of the Financial Markets by John J. Murphy. This book is considered the Bible of technical analysis and provides an in-depth overview of charting techniques and technical indicators. The New Market Wizards by Jack D. Schwager. This book is a follow-up to Market Wizards and includes interviews with successful traders from the 1990s. Options, Futures, and Other Derivatives by John C. Hull. This book is considered the definitive guide to derivatives and provides a comprehensive overview of options, futures, and other financial instruments. The Psychology of Trading by Brett N. Steenbarger. This book provides insights into the emotional and psychological challenges that traders face and offers strategies for managing these challenges. Fooled by Randomness by Nassim Nicholas Taleb. This book explores the role of luck and randomness in financial markets and challenges the notion that success in trading is solely due to skill. Trading in the Zone by Mark Douglas. This book explores the mental aspects of trading and provides strategies for developing a winning mindset. One Good Trade by Mike Bellafor. This book provides insights into the trading strategies and techniques used by the traders at SMB Capital, a proprietary trading firm. Please note that this is not an exhaustive list, and there are many other excellent books that traders may find useful. This section is focused on technical analysis and types of orders in financial markets. It provides an overview of the different types of orders that traders can use to execute trades, including market orders and limit orders. This section also explains how these orders work and provides examples to help readers understand how they can be used in practice. In addition to discussing types of orders, this section also covers some basic concepts related to technical analysis. This includes an explanation of support and resistance levels, as well as an overview of some common technical indicators that traders use to analyze market trends. Overall, this is a useful resource for anyone who is interested in learning more about technical analysis and how it can be used to make informed trading decisions in financial markets. Here is a list of the topics covered. 1. Introduction to technical analysis. 2. Types of charts. 3. Support and resistance levels. 4. Trend lines. 5. Moving averages. 6. Relative Strength Index, RSI. 7. Types of orders. A. Market order. B. Limit order. C. Stop order. D. Stop limit order. 8. Risks associated with different types of orders. Orders. Traders can use various types of orders to execute trades in the financial markets. Here are some common types of orders. Market order. This is an order to buy or sell a security at the best available price in the market. Example. Let's say you want to buy 100 shares of Apple stock, APL, and the current market price is $150. You place a market order to buy 100 shares of Apple. The order is executed immediately at the current market price of $150, and you pay $15,000 for the shares. If there is not enough liquidity in the market at the time you place the order may be filled at a slightly different price than the current market price. However, market orders are designed to be executed quickly, and the priority is given to filling the order as soon as possible at the prevailing market price. Limit order. This is an order to buy or sell a security at a specific price or better. A buy limit order is executed at or below the specified price, while a sell limit order is executed at or above the specified price. Example. Let's say you want to buy 100 shares of Microsoft, MSFD, but you think the current market price of $250 is too high, and you would prefer to buy the stock at a lower price. You could place a limit order to buy 100 shares of MSFD at a specific price, let's say $240. If the market price of MSFD drops to $240 or lower, your limit order will be executed and you will purchase 100 shares of MSFD at the limit price of $240 or lower. However, if the market price does not drop to $240 or lower, your limit order will not be filled. Limit orders are useful for traders who want to buy or sell at a specific price point and are willing to wait for the market to move in their favor. However, there is a risk that the limit order may not be filled if the market does not reach the specified price point. Stop order. This is an order to buy or sell a security once it reaches a specified price level. A stop order is typically used to limit potential losses or lock in profits. Example. Let's say you own 100 shares of Tesla, TSLA, and you are concerned that the stock price may start to decline. You could place a stop order to sell the shares if the stock price falls below a certain price, let's say $900. If the stock price of TSLA falls to $900 or below, your stop order will be triggered, and your broker will sell your 100 shares of TSLA at the next available market price. This means that you will sell your shares at the best available price after the stop price has been reached. Stop orders are useful for traders who want to limit their potential losses by selling their position if the market moves against them. However, there is a risk that the stop order may be triggered by a temporary market fluctuation, and the trader may end up selling at a lower price than they had anticipated. Stop limit order. This is a combination of a stop order and a limit order. It is an order to buy or sell a security once it reaches a specified price level, and once triggered, it becomes a limit order to buy or sell at a specified price or better. Example: let 100 shares of Amazon, AMZN, and you are concerned that the stock price may start to decline. You want to sell your shares if the price drops below $3,000, but you want to set a minimum price of $2,950 per share. You could place a stop limit order to sell 100 shares of AMZN with a stop price of $3,000 and a limit price of $2,950. If the stock price falls to $3,000 or below, your stop order will be triggered, and your broker will attempt to sell your shares at the limit price of $2,950 or higher. However, if the stock price falls below $2,950, your limit order will not be filled, and your position will remain open. This means that your shares will only be sold if the market price is above your limit price. Stop limit orders are useful for traders who want to sell at a specific price point but also want to limit their potential losses. They are a combination of a stop order, which triggers the sale at a specified price, and a limit order, which sets the minimum price that the trader is willing to accept for the sale. Trailing stop order. This is a stop order that is set at a fixed percentage or dollar amount below the market price for a long position or above the market price for a short position. As the market price moves in the trader's favor, the trailing stop order is adjusted accordingly. Let's say you own 100 shares of Netflix, NFLX, and you want to protect your profits while allowing for potential upside. You could place a trailing stop order to sell your shares if the price drops a certain percentage from its highest price since you bought the shares. For example, you could set a trailing stop order with a trail of 10% on your 100 shares of NFLX. If the stock price of NFLX rises to $600, the trailing stop order would be set at $540. $600 to 10% trail equals $540. If the stock price of NFLX continues to rise, the trailing stop order will adjust upward as well. However, if the stock price of NFLX falls by 10% or more from its highest point since you bought the shares, your trailing stop order will be triggered, and your broker will sell your 100 shares at the next available market price. Trailing stop orders are useful for traders who want to protect their profits while allowing for potential upside. They are a type of stop order that is designed to adjust with the market, and can help traders lock in gains while minimizing losses. Stick patterns. A candlestick pattern is a chart pattern used by technical analysts to help identify potential market trends and reversals. It is formed by the movement of the price of an asset over a specific time period, typically represented as a single candlestick on a price chart. Candlestick patterns use the open, high, low, and close prices of an asset to form a candlestick shape. The shape of the candlestick can provide information about the market sentiment, such as bullish, positive, or bearish, negative, sentiment, as well as potential areas of support and resistance. Some common candlestick patterns include the doji, which indicates indecision in the market, the hammer, which suggests a potential bullish reversal, and the shooting star, which suggests a potential bearish reversal. Candlestick patterns can be used in conjunction with other technical analysis tools to help traders make informed trading decisions. It is important to note that while candlestick patterns can be useful, they should not be relied upon solely for trading decisions, and traders should always consider other factors, such as market fundamentals and risk management strategies. Here's an example of a doji candlestick pattern in trading. A doji is a candlestick pattern that indicates indecision in the market. It forms when the opening and closing prices of a stock, currency, or commodity are very close to each other, resulting in a small or non-existent body and long upper and lower shadows. For example, let's say that the opening price of Apple, APL, stock is $150 and the closing price is $151. However, during the trading day, the stock price fluctuated significantly, reaching a high of $155 and a low of $148. The resulting candlestick for that day is a doji, with a very small or non-existent body and long upper and lower shadows. The doji pattern can indicate that the market is undecided about the direction of the asset's price. It may also signal a potential reversal if the doji appears after a strong uptrend or downtrend. Traders often use other technical indicators and chart patterns to confirm whether a reversal is likely or not. Here's an example of a hammer candlestick pattern in trading. A hammer is a bullish candlestick pattern that forms when a stock, currency, or commodity opens lower than its previous close but then rallies to close near or above its opening price. The pattern is characterized by a small real body with a long lower shadow and little to no upper shadow. For example, let's say that the opening price of Google stock is $1,200, but it falls to a low of $1,150 during the trading day, before rallying to close at $1,180. The resulting candlestick for that day is a hammer, with a small body, a long lower shadow, and little to no upper shadow. The hammer pattern indicates that the market may be experiencing a temporary pullback, but is likely to reverse and start moving higher. The long lower shadow shows that buyers were able to push the price up significantly from its low point, indicating strong buying pressure. Traders often look for confirmation of the hammer pattern by watching for a follow-through day where the stock price continues to rise. If the stock price continues to move higher, it could be an indication that the hammer pattern was a true signal of a bullish reversal. And resistance. Support and resistance are two key concepts in technical analysis used to identify potential levels where the price of an asset may stop moving in a certain direction, either up or down. Support is a price level where demand for an asset is expected to be strong enough to prevent the price from falling further. It is often seen as a floor in the price chart, below which the price is not expected to fall. Resistance is a price level where supply for an asset is expected to be strong enough to prevent the price from rising further. It is often seen as a ceiling in the price chart, above which the price is not expected to rise. These levels can be identified by looking at historical price data and observing where the price has previously bounced off or been unable to break through. Traders often use these levels as potential entry or exit points for their trades, with support being a potential buy point and resistance being a potential sell point. It's important to note that support and resistance levels are not exact prices, but rather areas or zones where price movements tend to stall or reverse. They can be influenced by various factors such as market sentiment, news events, and market fundamentals. Here's an example of support and resistance levels in the euro to US dollar currency pair. Let's say that the euro to US dollar exchange rate has been trending higher for several weeks and is currently trading at 1.2000. Traders notice that the price seems to be bouncing off a level around 1.1950 and is finding support at that level. This level of 1.1950 is called a support level. As the price continues to rise, it encounters a level around 1.2150 where it seems to be struggling to break above. This level of 1.2150 is called a resistance level. Traders use support and resistance levels to identify potential buy and sell signals. In this example, a trader might consider buying the euro to US dollar currency pair when the price reaches the support level at 1.1950, expecting the price to bounce higher. Conversely, a trader might consider selling the currency pair when the price reaches the resistance level at 1.2150, expecting the price to pull back. Traders also look for breakouts beyond support and resistance levels, as these can signal a change in the trend. In this example, if the euro to US dollar exchange rate breaks above the resistance level at 1.2150, it could signal a continuation of the uptrend. If the exchange rate breaks below the support level at 1.1950, it could signal a change in trend and the start of a downtrend. A trend line is a straight line drawn on a price chart that connects two or more price points, usually highs or lows. It is used in technical analysis to help identify and confirm trends in the price movement of an asset. A trend line can be drawn in an uptrend by connecting a series of higher lows, and in a downtrend by connecting a series of lower highs. When a trend line is broken, it may signal a change in trend direction. Traders use trend lines to help identify potential buying and selling opportunities. In an uptrend, a trader may look for a buying opportunity when the price reaches the trend line, while in a downtrend, a trader may look for a selling opportunity. Trend lines can be used in conjunction with other technical analysis tools, such as moving averages and indicators, to help confirm trends and identify potential entry and exit points for trades. It's important to note that trend lines are not exact predictions of future price movements, and should be used in conjunction with other forms of analysis and risk management strategies. Here's an example of how a trend line can be used in trading. Let's say that a trader is analyzing the price chart of a stock that has been trending higher for several months. The trader notices that the stock's price has been consistently bouncing off a rising trend line that connects the higher lows of the price chart. The trader can use the trend line to identify potential support levels and buying opportunities. If the stock's price pulls back to the trend line, the trader might consider buying the stock, expecting the price to bounce higher off the trend line and continue the uptrend. Conversely, if the price breaks below the trend line, the trader might consider selling the stock, as it could signal the end of the uptrend and the start of a downtrend. Trend lines can also be used to identify potential resistance levels and selling opportunities. If the price rallies to a trend line that connects the higher highs of the price chart, the trader might consider selling the stock, expecting the price to pull back and find resistance at the trend line. Overall, Trendlines are a useful tool for traders to identify potential support and resistance levels, as well as potential buying and selling opportunities. It's important to note that trendlines are subjective and can vary depending on how they are drawn, so traders should use other technical analysis tools to confirm their trading decisions. Structure. Market structure refers to the way in which the market is organized and operates, including the behavior and interactions of the various market participants, such as buyers and sellers. In trading, market structure analysis is a form of technical analysis that involves studying the patterns and movements of price and volume in the market to identify the underlying structure of the market. This includes identifying key levels of support and resistance, trend lines, and other chart patterns. Market structure analysis can help traders to identify potential trading opportunities and to manage their risk by identifying key levels where price movements may stall or reverse. For example, a trader may use market structure analysis to identify a key level of support where they can place a buy order with a stop loss just below the support level to manage their risk. Market structure analysis can also help traders to understand the broader context of the market, including the behavior of other market participants, such as institutional investors and market makers. This can help traders to make more informed trading decisions and to better manage their risk in the market. Here's an example of market structure in trading using the euro to US dollar currency pair. The market structure refers to the overall pattern of price movements in a financial market. In the case of the euro to US dollar currency pair, let's say that the market structure is a series of higher highs and higher lows, indicating an uptrend. Traders can use market structure to identify potential areas of support and resistance, as well as to determine the trend direction. For example, if the euro to US dollar currency pair has been consistently making higher highs and higher lows, traders can look for potential buying opportunities when the price pulls back to a previous support level, expecting the uptrend to continue. Conversely, if the euro to US dollar currency pair starts to make lower highs and lower lows, this could signal a change in the market structure and a potential downtrend. Traders can look for potential selling opportunities when the price rallies to a previous resistance level, expecting the price to reverse and continue the downtrend. By analyzing the market structure, traders can develop a better understanding of the overall price movements in a financial market, which can help them make more informed trading decisions. It's important to note that market structure can be subjective and can vary depending on the time frame and analysis method used, so traders should use other technical analysis tools to confirm their trading decisions. Timeframes in trading refer to the duration of time that is being analyzed or used to make trading decisions. Traders use different timeframes to analyze price movements and identify potential trading opportunities. There are several common timeframes used in trading, including tick, the smallest timeframe, which shows each individual trade that occurs in the market. Second, shows the price movements that occur within each second of trading. Minute, shows the price movements that occur within each minute of trading. Hourly, shows the price movements that occur within each hour of trading. Daily, shows the price movements that occur over the course of each trading day. Weekly, shows the price movements that occur over the course of each trading week. Monthly shows the price movements that occur over the course of each trading month. Traders use different time frames based on their trading style and strategy. For example, a day trader may use shorter time frames such as tick or minute charts to make quick trades based on short-term price movements, while a swing trader may use longer time frames such as daily or weekly charts to identify longer-term trends and hold positions for several days or weeks. It's important to note that different time frames can show different patterns and trends in the market, and traders may use multiple time frames to gain a more comprehensive understanding of the market, and to make more informed trading decisions. Here's an example of how different time frames can be used in trading. Let's say a trader is analyzing the euro to US dollar currency pair to identify potential trading opportunities. The trader can use different time frames to gain a better understanding of the market, and to develop a trading strategy. On a higher time frame, such as the daily chart, the trader can identify the overall trend of the market. If the daily chart shows a strong uptrend, the trader might focus on buying opportunities, looking for potential pullbacks to previous support levels to enter the market. On a lower time frame, such as the hourly chart, the trader can look for more precise entry and exit points. For example, the trader might look for a bullish price pattern, such as a hammer or bullish engulfing pattern, on the hourly chart to confirm a buying opportunity identified on the daily chart. On an even lower time frame, such as the 5-minute chart, the trader can monitor the price movements in real time and adjust their trading strategy accordingly. For example, the trader might use a moving average crossover strategy, waiting for the shorter-term moving average to cross above the longer-term moving average to confirm a buying opportunity. By using different time frames, traders can gain a more comprehensive understanding of the market, and develop a trading strategy that fits their trading style and risk tolerance. It's important to note that different time frames can provide different signals, so traders should use multiple time frames to confirm their trading decisions. Analysis. In technical analysis, top-down analysis using multiple time frames is a commonly used approach to analyzing price movements in a market. The idea behind this approach is to first analyze the longer-term trend of the market, and then use that analysis to inform trading decisions on shorter time frames. The top-down analysis using multiple time frames typically involves the following steps. Monthly or weekly charts. The first step is to look at the monthly or weekly charts to identify the longer-term trend of the market. This helps to identify the direction of the major trend, and whether it is bullish or bearish. Daily charts. Once the longer-term trend has been identified, the analysis moves to the daily charts to identify potential trading opportunities based on the trend. Intraday charts. Finally, the analysis moves to the intraday charts to fine-tune entry and exit points for trades, based on the longer-term trend and daily chart analysis. Using a top-down analysis approach with multiple time frames can help traders to identify potential trading opportunities based on the longer-term trend of the market, and to make more informed trading decisions based on a comprehensive analysis of the market. Here's an example of top-down analysis in technical analysis. Top-down analysis is a method of analyzing financial markets that starts with the big picture and works down to the details. In other words, the trader first looks at the long-term trend and then works their way down to the short-term trend. Let's say a trader is interested in trading the euro to US dollar currency pair using top-down analysis. The trader first looks at the monthly chart to identify the long-term trend of the market. If the monthly chart shows an uptrend, the trader might focus on buying opportunities, looking for potential pullbacks to previous support levels to enter the market. Next, the trader moves down to the weekly chart to gain a better understanding of the medium-term trend. If the weekly chart also shows an uptrend, the trader can confirm their bullish bias and continue to look for buying opportunities. Finally, the trader moves down to the daily chart to identify potential entry and exit points. The trader might use technical indicators, such as moving averages or oscillators, to identify overbought and oversold conditions and to confirm their trading decisions. By using top-down analysis, the trader can gain a better understanding of the market, and develop a trading strategy that fits their trading style and risk tolerance. It's important to note that top-down analysis can be time-consuming and may require multiple technical analysis tools, so traders should use other technical analysis tools to confirm their trading decisions. Strategies. A pin bar is a popular candlestick pattern used in trading that can indicate a potential trend reversal. A pin bar has a long tail or shadow, which represents a rejection of price at a certain level. The pin bar is characterized by a small body and a long wick, with the wick typically being 2 to 3 times the length of the body. The pattern can be bullish or bearish, depending on the location of the pin bar and the direction of the preceding trend. Here are a few pin bar trading strategies that traders commonly use. Pin bar as a reversal signal. A pin bar can indicate a potential reversal in the direction of the trend. For example, if the pin bar is located at the top of an uptrend, it may indicate that the trend is about to reverse and that a downtrend is likely to follow. Pin bar as a confirmation signal. Traders can also use pin bars to confirm potential trade entries. For example, if a trader identifies a potential trade based on a trend line or other technical indicator, a bullish pin bar can serve as confirmation that the market is indeed moving in the expected direction. Pin bar as a stop-loss signal. Traders can use pin bars as a signal to place a stop-loss order. For example, if a trader is in a long position and a bearish pin bar forms, it may indicate that the market is about to reverse and that the trader should exit the position to limit losses. Overall, pin bars can be a useful tool in a trader's arsenal, but as with any trading strategy, it is important to use them in conjunction with other technical indicators and to practice sound risk management. Bar strategies. The engulfing bar pattern is a popular candlestick pattern used in trading that can indicate a potential trend reversal. The pattern is characterized by a small body followed by a larger body that completely engulfs the previous candle's body, hence the name engulfing bar. Here are a few trading strategies that traders commonly use with engulfing bars. Engulfing bar as a reversal signal. An engulfing bar can indicate a potential reversal in the direction of the trend. For example, if the engulfing bar is a bullish pattern and it occurs after a downtrend, it may indicate that the trend is about to reverse and that an uptrend is likely to follow. Engulfing bar as a confirmation signal. Traders can also use engulfing bars to confirm potential trade entries. For example, if a trader identifies a potential trade based on a trend line or other technical indicator, a bullish engulfing bar can serve as confirmation that the market is indeed moving in the expected direction. Engulfing bar as a stop-loss signal. Traders can use engulfing bars as a signal to place a stop-loss order. For example, if a trader is in a long position and a bearish engulfing bar forms, it may indicate that the market is about to reverse and that the trader should exit the position to limit losses. Overall, engulfing bars can be a useful tool in a trader's arsenal, but as with any trading strategy, it is important to use them in conjunction with other technical indicators, and to practice sound risk management. Bar strategies. The inside bar pattern is another popular candlestick pattern used in trading that can indicate a potential trend continuation or reversal. The pattern is characterized by a smaller candlestick, the inside bar, that is completely engulfed by the preceding larger candlestick. Here are a few trading strategies that traders commonly use with inside bars. Inside bar as a continuation signal. An inside bar that forms within the context of a strong trend can indicate that the trend is likely to continue. Traders can look to enter long positions on a bullish inside bar that forms in an uptrend, or short positions on a bearish inside bar that forms in a downtrend. Inside bar as a breakout signal. Inside bars can also indicate that a breakout is likely to occur. For example, if an inside bar forms within a narrow range or consolidation pattern, a breakout in either direction may be imminent. Inside bar as a reversal signal. In some cases, an inside bar can indicate a potential trend reversal. For example, if an inside bar forms at a key resistance level, it may indicate that the market is about to reverse and that traders should look to enter short positions. Inside bar as a stop-loss signal. Traders can use inside bars as a signal to place a stop-loss order. For example, if a trader is in a long position and a bearish inside bar forms, it may indicate that the market is about to reverse and that the trader should exit the position to limit losses. As with any trading strategy, it is important to use inside bars in conjunction with other technical indicators and to practice sound risk management. Additionally, it is important to note that inside bars can sometimes result in false breakouts or signals, so traders should always be prepared to adjust their positions or exit trades quickly if necessary. Charts patterns. Here are 10 commonly used bar chart patterns in technical analysis. Double top. This pattern occurs when the price of an asset reaches a high, pulls back, and then makes another attempt to reach that same high, but fails to do so, resulting in a M-shaped pattern on the chart. Double bottom. This pattern is similar to the double top, but inverted. It occurs when the price reaches a low, bounces back up, and then returns to the same low again, resulting in a W-shaped pattern on the chart. Head and shoulders. This pattern is characterized by 3 peaks, with the middle peak being the highest. It is considered a bearish pattern and can signal a trend reversal. Inverse head and shoulders. This is the opposite of the head and shoulders pattern and is considered a bullish pattern that can signal a trend reversal. Bullish/bearish engulfing. A bullish engulfing pattern occurs when a small red candlestick is followed by a larger green candlestick that completely engulfs the previous candle. The opposite is true for a bearish engulfing pattern. Hammer. This pattern is characterized by a small body with a long lower shadow and little or no upper shadow. It is considered a bullish reversal pattern. Shooting star. This pattern is characterized by a small body with a long upper shadow and little or no lower shadow. It is considered a bearish reversal pattern. Morning star. This pattern is characterized by a long red candlestick followed by a small-bodied candlestick with a gap down, and then a long green candlestick. It is considered a bullish reversal pattern. Evening star. This pattern is the opposite of the morning star pattern, with a long green candlestick followed by a small-bodied candlestick with a gap up, and then a long red candlestick. It is considered a bearish reversal pattern. 3 black crows. This pattern is characterized by 3 consecutive long red candlesticks, and is considered a bearish reversal pattern. It is important to note that while these patterns can provide useful signals, they should always be used in conjunction with other technical indicators and analysis methods to confirm trading decisions. Efficiency hypothesis. The market efficiency hypothesis is a theory that suggests that financial markets are highly efficient and all available information is immediately reflected in asset prices. In other words, it is difficult to consistently achieve above-average returns through trading based on publicly available information because prices quickly adjust to new information. The implications of the market efficiency hypothesis for trading are significant. If the hypothesis is true, then it suggests that the vast majority of active traders will not be able to consistently outperform the market over the long term. This means that strategies such as technical analysis or fundamental analysis, which are based on the assumption that the market is inefficient, may not be as effective as believed. However, it is important to note that the market efficiency hypothesis is a theoretical construct and may not always hold true in practice. Some traders may still be able to generate above-average returns through a combination of skill and luck, and there may be certain market conditions or asset classes where the hypothesis is less applicable. In summary, the market efficiency hypothesis suggests that trading based on publicly available information may not be an effective way to consistently outperform the market. However, traders should keep in mind that the hypothesis is not a hard and fast rule and that there may be exceptions or nuances to its application in practice. There are 3 forms of the EMH: weak, semi-strong, and strong. The weak form states that all past market prices and volume information are already reflected in the current market prices. The semi-strong form adds that all publicly available information, including company financial reports and news events, is already reflected in the market prices. The strong form is the most stringent and states that all information, including insider information, is already reflected in the market prices. Numerous empirical studies have been conducted to test the EMH, with mixed results. Some studies have found evidence that markets are efficient, while others have found evidence to the contrary. One of the most famous and controversial studies is the work of Eugene Fama in the 1960s, which found evidence in favor of the EMH. However, other researchers have challenged the EMH, arguing that there are anomalies that cannot be explained by market efficiency. For example, the January effect and the momentum effect suggest that certain types of stocks consistently outperform the market in certain periods of time. In addition, behavioral finance suggests that investors do not always behave rationally, which could result in market inefficiencies. Overall, the debate about the EMH continues, with some researchers arguing that it is a useful framework for understanding financial markets, while others argue that it is an oversimplified and unrealistic assumption. Theory. The Dow theory is a theory of market analysis developed by Charles Dow in the late 19th century. It is based on the analysis of stock price movements and is one of the earliest forms of technical analysis. The Dow theory is based on 6 key principles. The market discounts everything. This means that the market price of a security reflects all available information, including fundamental factors such as earnings and economic indicators. The market has 3 trends. The Dow theory identifies 3 trends in the market: the primary trend, which can last from months to years and is the dominant trend; the secondary trend, which is shorter in duration and is a correction of the primary trend; and the minor trend, which is even shorter in duration and reflects day-to-day fluctuations in the market. The trend is confirmed by volume. In the Dow theory, price trends are confirmed by corresponding changes in trading volume. An uptrend should be accompanied by increasing trading volume, and a downtrend should be accompanied by decreasing trading volume. The trend is confirmed by multiple indices. The Dow theory suggests that the trend in one index should be confirmed by the trend in other indices. For example, if the Dow Jones Industrial Average is in an uptrend, this trend should also be reflected in other indices, such as the S&P 500. A trend remains in effect until it is clearly reversed. The Dow theory suggests that a trend will continue until there is clear evidence that it has been reversed. This evidence may include a change in the direction of trading volume or a break in a key support or resistance level. Trends have 3 phases. The Dow theory identifies 3 phases of a trend: the accumulation phase, when smart money is buying; the public participation phase, when the trend becomes more widely recognized; and the distribution phase, when smart money begins to sell. The Dow theory has been influential in the development of technical analysis, and is still widely used today. However, it should be noted that the theory has its limitations and may not always accurately predict market movements. While the Dow theory has been influential in technical analysis, there is limited empirical evidence to support its predictive power. Studies have shown mixed results, with some finding evidence in support of the Dow theory and others finding no significant correlation between the Dow Jones Industrial Average and DJTA. One study by Kamstra, Kramer, and Levi, 2003, found that the Dow theory had some predictive power in the long run, but not in the short run. Another study by George and Huang, 2004, found that while the Dow theory has some merit, it is not reliable enough to be a profitable trading strategy. Overall, while the Dow theory is an interesting concept, the empirical evidence for its effectiveness is limited and mixed. Therefore, investors should be cautious about relying solely on the Dow theory when making investment decisions. Waves. Elliott wave theory is a technical analysis approach used to forecast market trends and price movements based on the recurring wave patterns identified in financial market charts. This theory was developed by Ralph Nelson Elliott in the late 1920s and early 1930s, and it's based on the idea that markets move in a series of 5 waves in the direction of the primary trend, followed by 3 corrective waves in the opposite direction. According to Elliott wave theory, the price movements of financial markets reflect the collective psychology of investors, which alternates between optimism and pessimism. The theory identifies 2 types of waves: impulse waves and corrective waves. Impulse waves move in the direction of the primary trend and consist of 5 sub-waves, while corrective waves move in the opposite direction and consist of 3 sub-waves. The 5-wave impulse pattern is labeled 1, 2, 3, 4, and 5, and the 3-wave corrective pattern is labeled A, B, and C. These patterns repeat at different degrees of trend, forming larger or smaller wave structures, depending on the time frame being analyzed. Elliott wave analysts use various technical tools, such as Fibonacci retracements, to identify potential reversal points, which are where corrective waves end and impulse waves begin. However, it's important to note that Elliott wave analysis is subjective, and different analysts may interpret the same chart differently. While the Elliott wave theory has its critics, it remains a popular approach among some traders and analysts who use it as part of their trading strategies. Let's consider an example of how Elliott wave analysis can be used in practice. Suppose an investor is interested in trading a particular stock and has been analyzing its price movements, using Elliott wave analysis. They have identified what they believe to be an impulse wave, which is a 5-wave pattern that represents a strong directional move. The investor believes that the stock is currently in the 4th wave of the impulse, which is a corrective wave that typically retraces some of the gains from the 3rd wave. They also notice that the 4th wave is exhibiting a symmetrical triangle pattern, which suggests that the stock is likely to continue moving sideways for a period of time. Based on this analysis, the investor decides to wait for the completion of the 4th wave before entering a long position in the stock. They set a buy order at a price level that they believe represents the end of the corrective 4th wave and the start of the 5th wave. As the stock continues to move sideways within the symmetrical triangle, the investor monitors the price movements closely and adjusts their buy order accordingly. Eventually, the stock breaks out of the triangle pattern, and begins to move higher, confirming the start of the 5th wave. The investor's buy order is executed, and they hold the stock as it continues to rise within the 5th wave. They eventually sell their position when they believe that the 5th wave has completed, based on their analysis of the Elliott wave patterns. Overall, this example illustrates how Elliott wave analysis can be used to identify potential trading opportunities and make informed investment decisions based on price movements and patterns in financial markets. However, it's important to note that Elliott wave analysis is just one tool in a trader's toolkit, and should be used in conjunction with other technical and fundamental analysis techniques. Financial indicators. There are many financial indicators used in technical analysis, but here are 10 of the most commonly used ones. Moving averages. These are calculated by averaging the price of a security over a specific time period, and are used to identify trends. Relative Strength Index, RSI. This indicator measures the magnitude of recent price changes to determine if a security is overbought or oversold. Bollinger Bands. These bands are placed around the moving average of a security and help traders identify periods of high or low volatility. Stochastic Oscillator. This indicator compares the closing price of a security to its price range over a specific time period to determine if it is overbought or oversold. Moving Average Convergence Divergence, MACD. This indicator uses two moving averages to identify changes in trend momentum. Fibonacci Retracement. This tool is used to identify potential support and resistance levels based on the Fibonacci sequence. Ichimoku Cloud. This indicator uses a series of moving averages and other data points to help traders identify trends and potential support and resistance levels. On balance volume, OBV. This indicator measures buying and selling pressure based on the volume of a security. Average directional index, ADX. This indicator measures the strength of a trend and can help traders identify when a trend is weakening. Williams %R. This indicator measures the level of the closing price of a security relative to its high-low range over a specific time period, and is used to identify overbought or oversold conditions. Averages indicator. Moving averages are one of the most commonly used technical indicators in financial analysis. They are used to smooth out the price fluctuations of a security and identify trends. A moving average is simply the average price of a security over a specific time period, which is calculated by adding the prices together and then dividing by the number of prices in the period. There are different types of moving averages, including simple moving averages, SMA, and exponential moving averages, EMA. A simple moving average gives equal weight to each price in the time period, while an exponential moving average places more weight on the most recent prices. Moving averages are used to identify trends and to generate trading signals. When the price of a security is above its moving average, it is considered to be in an uptrend, and when the price is below its moving average, it is considered to be in a downtrend. Traders often use moving average crossovers, where the price of the security crosses above or below the moving average, as a signal to buy or sell the security. Moving averages can also be used to identify support and resistance levels. When the price of a security is approaching a moving average, it is likely to encounter resistance or support at the moving average. Traders use these levels to enter or exit positions, or to place stop-loss orders. There are several different types of moving averages that traders and analysts use in technical analysis. Here are some of the most commonly used types. Simple moving average, SMA. This is the most basic type of moving average, which calculates the average price over a certain period of time. It is calculated by adding up the closing prices over a specified period of time and then dividing by the number of periods. Weighted moving average, WMA. A weighted moving average assigns greater weight to more recent data, unlike a simple moving average where each data point has an equal weight. This means that the most recent prices have a greater impact on the moving average calculation. Exponential moving average, EMA. This moving average puts more weight on the most recent data, which means that it is more responsive to changes in price than a simple moving average. This is because it gives more weight to the most recent prices and applies an exponential function to the data, making it a more popular choice for short-term traders. Hull moving average, HMA. This moving average is designed to reduce lag and provide a smoother price trend line. It uses a weighted moving average, which emphasizes more recent prices, and is calculated by applying a series of weighted moving averages to the price data. Adaptive moving average, AMA. The adaptive moving average adjusts its sensitivity to price changes based on the volatility of the underlying asset. In other words, it becomes more responsive during periods of high volatility and less responsive during periods of low volatility. Overall, each type of moving average has its own strengths and weaknesses, and traders and analysts will often use a combination of different types to get a more complete picture of price movements. Consider an example of how moving averages can be used to analyze a stock's price movements and identify potential buy and sell signals. Suppose an investor is interested in trading a particular stock and has been analyzing its price movements using a 50-day moving average, MA, and a 200-day MA. They believe that the 50-day MA represents the short-term trend of the stock, while the 200-day MA represents the long-term trend. The investor notices that the stock's price has been trending above both the 50-day and 200-day MAs for some time, indicating a bullish trend. However, they also notice that the stock's price has recently dropped below the 50-day MA, which could be a sign of a short-term pullback. To confirm this potential signal, the investor looks for a cross of the 50-day MA and the 200-day MA. They believe that a cross of the 50-day MA below the 200-day MA is a bearish signal, indicating a potential reversal of the long-term trend. As the stock's price continues to decline, the 50-day MA eventually crosses below the 200-day MA, confirming the bearish signal. At this point, the investor decides to sell their position in the stock, anticipating further price declines. The investor may use moving averages to determine potential buy signals as well. For example, if the stock's price drops below the 200-day MA but remains above the 50-day MA, this could be a potential buying opportunity as the long-term trend remains intact and the short-term pullback may be temporary. Overall, this example illustrates how moving averages can be used to analyze a stock's price movements and identify potential buy and sell signals based on the short-term and long-term trends. However, it's important to note that moving averages should be used in conjunction with other technical and fundamental analysis techniques to make informed investment decisions. Strength Index, RSI. RSI stands for Relative Strength Index, which is a technical indicator used in financial analysis. It was developed by J. Wells Wilder in 1978, and is used to measure the strength of a security's price action. The RSI is calculated using a mathematical formula that compares the average gain and loss of a security's price over a specific period of time, typically 14 days. The RSI is expressed as a value between 0 and 100. When the RSI is above 70, it is considered to be overbought, which means that the security may be due for a price correction. When the RSI is below 30, it is considered to be oversold, which means that the security may be due for a price rebound. Traders use the RSI to identify trend reversals and to generate buy and sell signals. When the RSI crosses above 30, it is considered to be a buy signal, and when the RSI crosses below 70, it is considered to be a sell signal. Traders also use the RSI to confirm price trends and to identify divergences between the RSI and the security's price action, which can be a warning sign of a trend reversal. The RSI is a popular technical indicator because it is easy to use and can be applied to any security or market. However, traders should be cautious when relying solely on the RSI to make trading decisions, as it is just one tool among many in technical analysis. Let's consider an example of how the Relative Strength Index, RSI, can be used in technical analysis. Suppose an investor is interested in trading a particular stock and has been analyzing its price movements using the RSI. The RSI is a momentum oscillator that measures the speed and change of price movements, with values ranging from 0 to 100. The investor notices that the stock's RSI has been trending lower over the past few weeks, indicating that the stock is becoming oversold. The RSI is currently below 30, which is considered an oversold level, and may suggest that the stock is due for a bounce. To confirm this potential signal, the investor looks for a divergence between the RSI and the stock's price movements. A bullish divergence occurs when the stock's price makes a lower low while the RSI makes a higher low, indicating that the momentum of the stock is shifting to the upside. As the stock's price continues to decline, the investor notices that the RSI has formed a bullish divergence, with the RSI making a higher low while the stock's price makes a lower low. This confirms the oversold signal and the potential for a reversal. Based on this analysis, the investor decides to enter a long position in the stock, anticipating a potential bounce. They set a stop-loss order below the recent low, to limit their potential losses if the stock continues to decline. As the stock bounces higher, the investor monitors the RSI closely to determine when to exit their position. They may choose to sell their position when the RSI reaches an overbought level, typically above 70, indicating that the stock may be due for a pullback. Overall, this example illustrates how the RSI can be used to analyze a stock's price movements and identify potential buy and sell signals based on momentum and oversold/overbought levels. However, it's important to note that the RSI should be used in conjunction with other technical and fundamental analysis techniques to make informed investment decisions. Bands. Bollinger Bands are a technical analysis tool used to measure volatility and identify price trends in financial markets. They were developed by John Bollinger in the 1980s and consist of 3 lines on a price chart. The middle line is a simple moving average, typically 20 periods, while the upper and lower lines represent the standard deviation of price from the moving average. Bollinger Bands adjust to market volatility by widening during periods of high volatility and contracting during periods of low volatility. Traders use Bollinger Bands to identify potential trading opportunities. When prices move outside of the upper or lower Bollinger Band, it is seen as a signal of a potential trend reversal. Traders may use this signal to enter or exit trades, depending on their strategy. Bollinger Bands can also be used to identify the strength of a trend. When prices consistently stay near the upper or lower Bollinger Band, it indicates a strong trend. When prices move towards the middle line, it may indicate a weaker trend. Bollinger Bands are a popular technical analysis tool because they are simple to use and can be applied to any security or market. However, traders should use Bollinger Bands in combination with other technical indicators and fundamental analysis to make informed trading decisions. Let's consider an example of how Bollinger Bands can be used in currency trading. Suppose a trader is interested in trading the euro to US dollar currency pair and has been analyzing its price movements using Bollinger Bands. Bollinger Bands are a technical analysis tool that measures the volatility of an asset and consists of 3 lines, a simple moving average (SMA) line in the middle, and 2 outer bands that are typically 2 standard deviations away from the SMA line. The trader notices that the euro to US dollar has been trading within a narrow range for the past few days, with the price bouncing back and forth between the upper and lower Bollinger Bands. This indicates that the currency pair is experiencing low volatility. The trader also notices that the upper and lower Bollinger Bands are relatively close together, suggesting that a breakout may be imminent. They decide to wait for a clear signal before taking a position. A few days later, the euro to US dollar price breaks out of the narrow trading range and starts to move higher, with the price crossing above the upper Bollinger Band. This indicates that the currency pair is experiencing higher volatility and may continue to move higher. To confirm this signal, the trader looks for other technical indicators. They notice that the RSI is also trending higher, indicating that the currency pair is gaining momentum. Based on this analysis, the trader decides to enter a long position in the euro to US dollar, anticipating a potential uptrend. They set a stop-loss order below the recent low, to limit their potential losses if the currency pair starts to decline. As the euro to US dollar continues to move higher, the trader monitors the Bollinger Bands closely to determine when to exit their position. They may choose to sell their position when the price reaches the upper Bollinger Band again or when the price starts to move below the SMA line. Overall, this example illustrates how Bollinger Bands can be used in currency trading to identify potential buy and sell signals based on volatility and breakouts. However, it's important to note that Bollinger Bands should be used in conjunction with other technical and fundamental analysis techniques to make informed trading decisions. Stochastic oscillator. A stochastic oscillator is a technical analysis tool that measures the momentum of price movements in financial markets. It was developed in the 1950s by George Lane and it is commonly used by traders to identify overbought and oversold conditions in an asset's price. The stochastic oscillator compares the closing price of an asset to its price range over a specified period of time. The result is a number between 0 and 100 that indicates the level of momentum in the asset's price movement. A reading above 80 is considered overbought, while a reading below 20 is considered oversold. Traders use the stochastic oscillator to identify potential trend reversals. When an asset's price is overbought, it may indicate that the price has risen too far too fast and is due for a correction. Conversely, when an asset's price is oversold, it may indicate that the price has fallen too far too fast and is due for a rebound. The stochastic oscillator is often used in combination with other technical indicators and chart patterns to make informed trading decisions. However, it is important for traders to understand the limitations of the stochastic oscillator and to use it in conjunction with other analysis techniques to confirm potential trade signals. Let's consider an example of how stochastic oscillators can be used in technical analysis. Suppose a trader is interested in trading a particular stock and has been analyzing its price movements, using stochastic oscillators. Stochastic oscillators are a momentum indicator that measures the strength and speed of price movements, with values ranging from 0 to 100. The trader notices that the stock's price has been trending higher over the past few weeks but has recently started to decline. They decide to use stochastic oscillators to identify potential buy signals. To use stochastic oscillators, the trader first looks at the recent price action of the stock. They notice that the stock's price has been making higher highs and higher lows, indicating an uptrend. However, the recent decline has caused the stochastic oscillator to drop below 20, which is considered an oversold level and may indicate that the stock is due for a bounce. The trader then looks for a crossover between the two lines of the stochastic oscillator, the %K line and the %D line. A bullish crossover occurs when the %K line crosses above the %D line, indicating that the momentum of the stock is shifting to the upside. As the stock's price continues to decline, the trader notices that the stochastic oscillator has formed a bullish crossover, with the %K line crossing above the %D line. This confirms the oversold signal and the potential for a reversal. Based on this analysis, the trader decides to enter a long position in the stock, anticipating a potential bounce. They set a stop-loss order below the recent low, to limit their potential losses if the stock continues to decline. As the stock bounces higher, the trader monitors the stochastic oscillator closely to determine when to exit their position. They may choose to sell their position when the stochastic oscillator reaches an overbought level, typically above 80, indicating that the stock may be due for a pullback. Overall, this example illustrates how stochastic oscillators can be used to analyze a stock's price movements and identify potential buy and sell signals based on momentum and oversold/overbought levels. However, it's important to note that stochastic oscillators should be used in conjunction with other technical and fundamental analysis techniques to make informed investment decisions. Indicator. Moving Average Convergence Divergence, MACD, is a popular technical analysis tool used by traders to identify trends and momentum in an asset's price movements. It is a trend-following momentum indicator that compares the difference between two moving averages of an asset's price. The MACD indicator is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA, and plotting the result as a line on a chart. A 9-period EMA, called the signal line, is then plotted on top of the MACD line. Traders use the intersection of the MACD line and the signal line as potential buy or sell signals. The MACD indicator oscillates above and below a zero line, which represents the point at which the 12-period EMA and the 26-period EMA are equal. When the MACD line crosses above the signal line, it is considered a bullish signal, indicating that momentum may be shifting to the upside. Conversely, when the MACD line crosses below the signal line, it is considered a bearish signal, indicating that momentum may be shifting to the downside. Traders also use the MACD indicator to identify divergences, which occur when the MACD line moves in a different direction than the asset's price. Bullish divergences occur when the MACD line makes a higher low while the price makes a lower low, which may indicate that a bullish reversal is imminent. Bearish divergences occur when the MACD line makes a lower high while the price makes a higher high, which may indicate that a bearish reversal is imminent. Overall, the MACD indicator is a useful tool for traders to identify trends and momentum in an asset's price movements, and can be used in conjunction with other technical indicators and chart patterns to make informed trading decisions. Let's consider an example of how the Moving Average Convergence Divergence, MACD, indicator can be used in currency trading. Suppose a trader is interested in trading the pound sterling to US dollar currency pair and has been analyzing its price movements, using MACD. MACD is a technical analysis tool that measures the difference between two exponential moving averages and is used to identify trend reversals, momentum shifts, and potential buy and sell signals. The trader notices that the pound sterling to US dollar has been in a downtrend for the past few days, with the price consistently making lower lows and lower highs. They decide to use MACD to confirm the trend and identify potential opportunities. To use MACD, the trader first calculates the MACD line by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. They then calculate the signal line, which is typically a 9-period EMA of the MACD line. The trader notices that the MACD line has been trending lower, indicating that the pound sterling to US dollar is experiencing downward momentum. However, they also notice that the MACD line is approaching the signal line, which may indicate a potential reversal. As the MACD line crosses above the signal line, the trader takes this as a potential buy signal, indicating that the pound sterling to US dollar may be reversing its downtrend and potentially moving higher. They decide to enter a long position in the pound sterling to US dollar, anticipating a potential uptrend. To manage their risk, the trader sets a stop-loss order below the recent low, to limit their potential losses if the currency pair starts to decline again. As the pound sterling to US dollar continues to move higher, the trader monitors the MACD indicator closely to determine when to exit their position. They may choose to sell their position when the MACD line crosses below the signal line again, indicating that the momentum is shifting back to the downside. Alternatively, they may choose to hold their position and use other technical and fundamental analysis techniques to determine when to exit their trade. Overall, this example illustrates how MACD can be used in currency trading to identify potential trend reversals and buy/sell signals based on momentum and moving averages. However, it's important to note that MACD should be used in conjunction with other technical and fundamental analysis techniques to make informed trading decisions. Fibonacci retracement. Fibonacci retracement is a technical analysis tool used to identify potential levels of support and resistance on a price chart. The tool is based on the idea that prices tend to retrace a predictable portion of a move, after which they continue in the original direction. The Fibonacci retracement tool uses horizontal lines to indicate where possible levels of support or resistance might occur. These lines are drawn by connecting the high point and the low point of a price move, and then dividing the vertical distance by the key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, and 100%. These ratios are derived from the Fibonacci sequence, a mathematical sequence of numbers in which each number is the sum of the two preceding ones. When prices are trending higher, the Fibonacci retracement tool is used to identify potential levels of support where buyers may step in and push prices higher again. Conversely, when prices are trending lower, the tool is used to identify potential levels of resistance where sellers may step in and push prices lower again. Traders use Fibonacci retracement in conjunction with other technical analysis tools to help identify potential entry and exit points for their trades. However, it is important to note that Fibonacci retracement levels should not be relied on as the sole basis for making trading decisions, and should be used in combination with other technical and fundamental analysis tools. Let's consider an example of how Fibonacci retracements can be used in technical analysis. Suppose a trader is interested in trading a particular stock and has been analyzing its price movements, using Fibonacci retracements. Fibonacci retracements are a technical analysis tool that uses horizontal lines to indicate areas of support or resistance at the key Fibonacci levels before the price continues in the original direction. The trader notices that the stock's price has been trending higher over the past few weeks but has recently started to decline. They decide to use Fibonacci retracements to identify potential areas of support where the stock may potentially reverse and start trending higher again. To use Fibonacci retracements, the trader first identifies the highest point of the recent uptrend and the lowest point of the recent downtrend. They then use the Fibonacci retracement tool to draw horizontal lines at the key Fibonacci levels of 23.6%, 38.2%, 50%, 61.8%, and 100%. The trader notices that the stock's price has retraced to the 38.2% Fibonacci level, which is a potential area of support. They also notice that this level coincides with a previous support level, indicating that there may be additional buying pressure at this level. Based on this analysis, the trader decides to enter a long position in the stock, anticipating a potential bounce from the 38.2% Fibonacci retracement level. They set a stop-loss order below the recent low, to limit their potential losses if the stock continues to decline. As the stock bounces higher, the trader monitors the Fibonacci retracement levels closely to determine when to exit their position. They may choose to sell their position when the stock reaches a previous resistance level or a Fibonacci level above the current price, indicating that the stock may be overbought and due for a pullback. Overall, this example illustrates how Fibonacci retracements can be used to analyze a stock's price movements and identify potential areas of support and resistance based on key Fibonacci levels. However, it's important to note that Fibonacci retracements should be used in conjunction with other technical and fundamental analysis techniques to make informed investment decisions. Ichimoku Cloud. Ichimoku Cloud, also known as Ichimoku Kinko Hyo, is a technical analysis tool used to identify potential trend reversals, and to gauge the strength of an existing trend. The indicator was developed in Japan by Goichi Hosoda, a journalist, in the late 1930s. Ichimoku Cloud consists of several components, including a cloud, or kumo, a baseline, or Kijun-sen, a conversion line, or Tenkan-sen, and a lagging line, or Chiku span. The cloud is the main component of the Ichimoku Cloud indicator and is formed by plotting two lines, the Senko span A and Senko span B. The cloud is used to identify areas of support and resistance, as well as to help determine trend direction. When the price is above the cloud, it is generally considered a bullish signal, while a price below the cloud is a bearish signal. The baseline, or Kijun-sen, is a moving average that is calculated over 26 periods. The conversion line, or Tenkan-sen, is a moving average calculated over 9 periods. These lines are used to identify trend direction and potential areas of support and resistance. The lagging line, or Chiku span, is plotted 26 periods back on the chart and is used to confirm trend direction. When the lagging line is above the price, it is a bullish signal, while a lagging line below the price is a bearish signal. Overall, Ichimoku Cloud is a comprehensive technical analysis tool that can provide traders with a clear picture of trend direction and potential areas of support and resistance. Let's consider an example of how the Ichimoku Cloud indicator can be used in currency trading. Suppose a trader is interested in trading the US dollar to Japanese yen currency pair and has been analyzing its price movements, using the Ichimoku Cloud Indicator. Ichimoku Cloud is a technical analysis tool that uses multiple lines and a shaded area to help identify potential buy and sell signals, support and resistance levels, and trend direction. The trader notices that the US dollar to Japanese yen has been in a downtrend for the past few weeks, with the price consistently making lower lows and lower highs. They decide to use Ichimoku Cloud to confirm the trend and identify potential opportunities. To use Ichimoku Cloud, the trader first looks at the cloud itself, which is a shaded area formed by the span A and span B lines. If the price is above the cloud, it is considered a bullish signal, while if the price is below the cloud, it is considered a bearish signal. The trader also looks at the Tenkan-sen and Kijun-sen lines, which are used to indicate short-term and long-term trend direction, respectively. When the Tenkan-sen line crosses above the Kijun-sen line, it is considered a potential buy signal, while when the Tenkan-sen line crosses below the Kijun-sen line, it is considered a potential sell signal. The trader notices that the US dollar to Japanese yen is currently below the cloud, indicating a bearish trend. They also notice that the Tenkan-sen line has crossed below the Kijun-sen line, confirming the bearish trend and potentially indicating a sell signal. Based on this analysis, the trader decides to enter a short position in the US dollar to Japanese yen, anticipating a further decline in price. They set a stop-loss order above the recent high, to limit their potential losses if the currency pair starts to move higher again. As the US dollar to Japanese yen continues to decline, the trader monitors the Ichimoku Cloud Indicator closely to determine when to exit their position. They may choose to exit their position when the Tenkan-sen line crosses back above the Kijun-sen line, indicating a potential trend reversal. Overall, this example illustrates how the Ichimoku Cloud Indicator can be used in currency trading to identify potential buy and sell signals, support and resistance levels, and trend direction. However, it's important to note that Ichimoku Cloud should be used in conjunction with other technical and fundamental analysis techniques to make informed trading decisions. Volume, OBV. On balance volume, OBV, is a technical analysis indicator used to measure the buying and selling pressure of a security. It was developed by Joseph Granville in the 1960s. OBV takes into account the volume of trades and whether they were bullish or bearish to calculate the cumulative total of buying and selling pressure. The OBV line is plotted on a chart, and its direction is used to determine the strength of a trend. If the OBV line is trending upwards, it suggests that the buying pressure is increasing, which could indicate a bullish trend. Conversely, if the OBV line is trending downwards, it suggests that the selling pressure is increasing, which could indicate a bearish trend. OBV can also be used to identify divergences between the price action and the indicator. For example, if the price is trending upwards, but the OBV line is trending downwards, it could suggest that the trend is weakening, and a reversal could be imminent. Overall, OBV is a useful indicator for traders to gauge the strength of a trend and to identify potential reversals. However, like all technical indicators, it should be used in conjunction with other forms of analysis, and not relied on exclusively. Let's consider an example of how the on-balance volume, OBV, indicator can be used in stock trading. Suppose a trader is interested in trading shares of a particular company and has been analyzing its price movements, using the OBV indicator. OBV is a technical analysis tool that uses volume to help identify potential buy and sell signals and confirm price trends. The trader notices that the company's stock price has been steadily increasing over the past few months, but they want to confirm the trend using OBV. To use OBV, the trader looks at the volume of shares traded on days when the price goes up versus days when the price goes down. If the volume is higher on days when the price goes up, it is considered a bullish signal, while if the volume is higher on days when the price goes down, it is considered a bearish signal. If the volume is relatively stable regardless of price movements, it indicates a neutral signal. The trader calculates the OBV by adding the volume on days when the price goes up and subtracting the volume on days when the price goes down. The resulting number is then added to the previous day's OBV to get the current OBV. The trader notices that the OBV for the company's stock has been steadily increasing along with the price, indicating that there is strong buying pressure and confirming the bullish trend. They decide to enter a long position in the stock, anticipating further price increases. As the stock price continues to rise, the trader monitors the OBV indicator closely to determine when to exit their position. They may choose to exit their position if the OBV starts to decline, indicating a potential trend reversal and a decrease in buying pressure. Overall, this example illustrates how the OBV indicator can be used in stock trading to identify potential buy and sell signals and confirm price trends. However, it's important to note that OBV should be used in conjunction with other technical and fundamental analysis techniques to make informed trading decisions. Directional Index, ADX. The Average Directional Index, ADX, is a technical indicator that measures the strength of a trend. Developed by J. Wells Wilder, the ADX is calculated by taking the average of two other indicators, the Positive Directional Index, plus DI, and the Negative Directional Index, DI. The ADX values range from 0 to 100. A value of 0 indicates that there is no trend, while a value of 100 indicates that there is a strong trend. Traders use the ADX to identify when a trend is present and to determine the strength of that trend. In general, a reading above 25 is considered to indicate a strong trend, while a reading below 20 indicates a weak trend. Traders may also use the ADX to identify when a trend is weakening or when a new trend is beginning. A crossover between the plus DI and DI lines may signal a change in trend direction, while a cross above or below the 25 or 20 level may also indicate a change in trend strength. The ADX is often used in combination with other technical indicators and chart patterns to make trading decisions. Let's consider an example of how the Average Directional Index, ADX, indicator can be used in currency trading. Suppose a trader is interested in trading the euro to US dollar currency pair and has been analyzing its price movements using the ADX indicator. ADX is a technical analysis tool that measures the strength of a trend and helps identify potential buy and sell signals. The trader notices that the euro to US dollar pair has been trading in a range for the past few weeks, but they want to confirm the lack of a trend using ADX. To use ADX, the trader looks at the value of the indicator and the direction of the ADX line. If the ADX value is below 20, it indicates that there is no clear trend and the market is ranging. If the ADX value is between 20 and 40, it indicates that a trend may be starting to form. If the ADX value is above 40, it indicates that there is a strong trend in place. In addition, the direction of the ADX line can also provide information about the strength and direction of the trend. If the ADX line is sloping upwards, it indicates that the trend is gaining strength. If the ADX line is sloping downwards, it indicates that the trend is losing strength. The trader calculates the ADX by averaging the difference between the positive and negative directional indicators, DI plus and DI, over a specified period. The resulting value is then plotted on a chart alongside the ADX line. The trader notices that the ADX value for the euro to US dollar pair is below 20 and the ADX line is flat, indicating that there is no clear trend and the market is ranging. They decide to avoid taking any positions in the pair until a clear trend emerges. As the market continues to trade in a range, the trader continues to monitor the ADX indicator closely to determine when a trend may be starting to form. If the ADX value starts to increase and the ADX line starts to slope upwards, it may indicate that a trend is starting to form and the trader may consider taking a position in the direction of the trend. Overall, this example illustrates how the ADX indicator can be used in currency trading to measure the strength of a trend and help identify potential buy and sell signals. However, it's important to note that ADX should be used in conjunction with other technical and fundamental analysis techniques to make informed trading decisions. %R indicator. Williams %R is a technical analysis oscillator used to identify overbought and oversold conditions in financial markets. It was developed by Larry Williams and is also known as the Williams % range or %R. The Williams %R oscillator is similar to the stochastic oscillator, but it is plotted upside down, with values ranging from 0 at the top to -100 at the bottom. The Williams %R formula calculates the current closing price relative to the high-low range of the specified time period, usually 14 periods, and expresses it as a percentage. %R equals highest high, close, highest high, lowest low, x minus 100. The Williams %R oscillator fluctuates between 0 and -100. Values between 0 and -20 indicate an overbought condition, while values between -80 and -100 indicate an oversold condition. Traders often use the Williams %R oscillator in conjunction with other technical indicators to confirm potential trend changes or to generate trading signals. Like other technical indicators, the Williams %R oscillator has limitations and should not be used in isolation. False signals can occur in ranging markets, and extreme values can persist for extended periods during trending markets. Therefore, traders should use the Williams %R oscillator in combination with other indicators and technical analysis tools to make informed trading decisions. Let's consider an example of how the Williams %R indicator can be used in trading. Suppose a trader is interested in trading the stock of company X and has been analyzing its price movements, using the Williams %R indicator. Williams percent-R is a technical analysis tool that measures momentum and helps identify potential buy and sell signals. The trader notices that company X's stock has been trending downwards over the past few days, but they want to confirm the bearish trend using Williams percent-R. To use Williams percent-R, the trader looks at the value of the indicator and the direction of the percent-R line. Williams percent-R ranges from 0 to -100, with readings above -20 indicating overbought conditions and readings below -80 indicating oversold conditions. If the percent-R line crosses above -20, it may indicate that the stock is overbought and due for a pullback. If the percent-R line crosses below -80, it may indicate that the stock is oversold and due for a bounce. The trader calculates Williams percent-R by subtracting the current closing price from the highest high over a specified period, and then dividing by the difference between the highest high and the lowest low over the same period. The resulting value is then multiplied by -100 to get the percent-R reading. The trader notices that the percent-R reading for company X's stock is below -80 and the percent-R line is sloping upwards, indicating that the stock is oversold and potentially due for a bounce. They decide to take a long position in the stock, anticipating a rebound in price. As the market continues to trade, the trader continues to monitor the Williams percent-R indicator closely to determine when to exit their position. If the percent-R line starts to slope downwards and crosses above -80, it may indicate that the oversold conditions have abated and the trader may consider closing their position. Overall, this example illustrates how the Williams percent-R indicator can be used in trading to measure momentum and help identify potential buy and sell signals. However, it's important to note that Williams percent-R should be used in conjunction with other technical and fundamental analysis techniques to make informed trading decisions. Limitations of the technical indicators. Technical indicators are tools used by traders to analyze financial markets and make trading decisions. However, there are some limitations to using technical indicators, including lagging indicators. Most technical indicators are based on past price and volume data, which means they are lagging indicators. They can be slow to signal changes in market trends or price movements, and by the time a trader receives a signal, the market may have already moved significantly. False signals. Technical indicators can generate false signals, particularly in choppy or range-bound markets. These signals can result in trades that are unprofitable or result in losses. Over-reliance. Traders may become over-reliant on technical indicators and ignore other important factors, such as fundamental analysis or market news. This can lead to missed opportunities or losses. Limited scope. Technical indicators are designed to measure specific aspects of market activity, such as momentum, trend, or volatility. However, they do not provide a complete picture of market conditions and cannot capture all market variables that may impact trading decisions. Similarity of indicators. Many technical indicators are derived from similar underlying principles, which means they can produce similar signals or conflicting signals. Traders may need to use multiple indicators to get a clearer view of market conditions. Poor performance in unusual market conditions. Technical indicators are based on historical data and assumptions about market behavior. They may perform poorly or generate misleading signals during unusual market conditions, such as during a financial crisis or other major event. Overall, technical indicators can be helpful tools for traders, but they should be used in conjunction with other methods of analysis, and should not be relied on exclusively. Traders should also be aware of the limitations of technical indicators and use them with caution. This section is focused on fundamental analysis and the importance of interest rates in trading. It provides an overview of what fundamental analysis is and how it can be used to make informed trading decisions. This section explains the significance of interest rates in trading, highlighting how they impact borrowing costs, currency exchange rates, stock and bond prices, and economic growth. It also discusses how traders can use this knowledge to inform their investment decisions. Additionally, this section provides examples of commitments of traders, COT, reports using crude oil futures and currencies such as the euro, EUR, and the US dollar, USD. These reports provide information on long and short contracts held by different groups, as well as net positions. Overall, this section serves as a comprehensive guide for traders looking to gain a better understanding of fundamental analysis, and the role that interest rates play in trading. Here is a more exhaustive summary of the topics covered. 1. Introduction to Fundamental Analysis. This section provides an overview of what fundamental analysis is and how it can be used to make informed trading decisions. 2. Economic indicators. This section explains the significance of economic indicators such as gross domestic product, GDP, inflation, and employment data, and how they can be used in fundamental analysis. 3. Interest rates. This section highlights how interest rates impact borrowing costs, currency exchange rates, stock and bond prices, and economic growth. 4. Commitments of traders, COT, reports. This section provides examples of COT reports using crude oil futures and currencies such as the euro, EUR, and the US dollar, USD. These reports provide information on long and short contracts held by different groups, as well as net positions. 5. Technical analysis. This section provides an overview of what technical analysis is and how it can be used in trading. 6. Trading strategies. This section discusses various trading strategies, such as trend following, mean reversion, and breakout trading. Rates. Interest rates are a critical component of trading, as they have a significant impact on financial markets and the economy. Here are some reasons why interest rates are important in trading. Affect borrowing costs. Interest rates impact the cost of borrowing money, whether it is for individuals, corporations or governments. Higher interest rates mean that it becomes more expensive to borrow money, which can impact investment decisions and trading strategies. Affect currency exchange rates. Interest rates can impact currency exchange rates. Higher interest rates in one country can lead to an increase in the value of that country's currency, as investors seek to earn higher returns on their investments. Affect stock and bond prices. Changes in interest rates can impact stock and bond prices. For example, rising interest rates may make bonds more attractive to investors, which could lead to a decrease in stock prices as investors shift their focus to bonds. Affect economic growth. Interest rates can impact economic growth, as higher interest rates can lead to decreased consumer and business spending, which can slow down the economy. Lower interest rates, on the other hand, can stimulate economic growth by making borrowing cheaper and increasing consumer and business spending. Affect inflation. Interest rates can also impact inflation, as higher interest rates can slow down inflation by decreasing consumer and business spending. Lower interest rates, on the other hand, can increase inflation by stimulating spending. Overall, interest rates are a crucial factor in trading, as they impact a wide range of financial market indicators and economic factors. Traders need to be aware of changes in interest rates and how they may impact their investments and trading strategies. Inflation is a measure of the rate at which prices for goods and services are increasing in an economy over time. Inflation can have a significant impact on trading, as it affects many aspects of the financial markets, including interest rates. Inflation can impact interest rates, as central banks may raise interest rates to combat rising inflation. Higher interest rates can make borrowing more expensive, which can slow down economic growth and reduce the attractiveness of stocks and other investments. Currency exchange rates. Inflation can also impact currency exchange rates. If a country has a high rate of inflation, its currency may lose value compared to other currencies, as investors seek to hold currencies that are expected to hold their value over time. Commodity prices. Inflation can impact the prices of commodities such as oil, gold, and silver. As the cost of goods and services increases, the cost of producing and transporting commodities also increases, which can lead to higher prices for these goods. Stock prices. Inflation can impact stock prices, as companies may experience higher costs for raw materials and labor, which can impact their profitability. Higher inflation may also lead to higher interest rates, which can make stocks less attractive to investors. Bond prices. Inflation can also impact bond prices. When inflation is rising, bond yields may also rise, as investors demand higher returns to compensate for the impact of inflation on the purchasing power of their investments. Overall, inflation can have a significant impact on trading, as it affects many aspects of the financial markets. Traders need to be aware of changes in inflation rates and how they may impact their investments and trading strategies. Policy. Monetary policy is a tool used by central banks to manage the money supply and influence interest rates in an economy. Central banks use monetary policy to achieve their economic objectives, such as controlling inflation, stabilizing economic growth, and promoting employment. Monetary policy can impact trading in several ways. Interest rates. One of the primary tools of monetary policy is adjusting interest rates. Central banks can increase or decrease interest rates to influence borrowing and spending behavior in the economy. Changes in interest rates can have a significant impact on financial markets, such as the stock and bond markets. Currency exchange rates. Monetary policy can also impact currency exchange rates. By adjusting interest rates, central banks can influence the value of their currency relative to other currencies, which can impact international trade and investments. Liquidity. Monetary policy can impact the availability of liquidity in financial markets. Central banks can provide liquidity to banks and financial institutions through open market operations or other measures, which can impact the supply of credit and borrowing costs in the economy. Inflation. Monetary policy is a crucial tool for controlling inflation. Central banks use various policy tools to manage inflation, such as adjusting interest rates, managing the money supply, and influencing consumer spending behavior. Overall, monetary policy has a significant impact on trading, as it can influence interest rates, currency exchange rates, and liquidity in financial markets. Traders need to be aware of changes in monetary policy and how they may impact their investments and trading strategies. Banks around the world. There are several central banks around the world, but some of the largest and most influential ones include U.S. Federal Reserve, Fed. The Fed is the central bank of the United States and is responsible for implementing monetary policy to achieve its dual mandate of promoting maximum employment and price stability. The Fed's policies include adjusting interest rates, managing the money supply, and providing liquidity to financial markets. European Central Bank, ECB. The ECB is the central bank of the European Union, and is responsible for maintaining price stability and supporting economic growth. The ECB's policies include adjusting interest rates, managing the money supply, and purchasing government bonds. Bank of Japan, BOJ. The BOJ is the central bank of Japan and is responsible for implementing monetary policy to achieve its price stability target of 2% inflation. The BOJ's policies include adjusting interest rates, managing the money supply, and purchasing government bonds and exchange-traded funds, ETFs. People's Bank of China, PBOC. The BOC is the central bank of China, and is responsible for implementing monetary policy to support economic growth and maintain financial stability. The BOC's policies include adjusting interest rates, managing the money supply, and providing liquidity to financial markets. Bank of England, BOE. The BOE is the central bank of the United Kingdom and is responsible for implementing monetary policy to achieve its inflation target of 2%. The BOE's policies include adjusting interest rates, managing the money supply, and purchasing government bonds. Each central bank has its own unique policies and objectives, but they all play a critical role in managing their respective economies and supporting financial stability. Traders need to be aware of changes in central bank policies and how they may impact their investments and trading strategies. Reserve System. The Federal Reserve System, commonly referred to as the Fed, is the central banking system of the United States. It was created in 1913 by the Federal Reserve Act, signed into law by President Woodrow Wilson, and it operates independently of the federal government. The Fed has several key responsibilities, including conducting monetary policy. The Fed is responsible for setting monetary policy to achieve its dual mandate of promoting maximum employment and price stability. This includes adjusting interest rates, managing the money supply, and providing liquidity to financial markets. Supervising and regulating banks. The Fed is responsible for supervising and regulating banks to ensure the safety and soundness of the banking system. It also oversees other financial institutions, such as credit unions and savings and loan associations. Maintaining financial stability. The Fed plays a critical role in maintaining financial stability by providing liquidity to financial markets during times of stress and by working with other regulators to monitor and mitigate systemic risks. Providing payment services. The Fed provides payment and settlement services to financial institutions to facilitate the transfer of funds and securities between banks. The Federal Reserve System is composed of several different entities, including the Board of Governors. The Board of Governors is the main governing body of the Fed and is responsible for setting monetary policy and supervising banks. Federal Reserve Banks. There are 12 Federal Reserve Banks located throughout the United States. They are responsible for implementing monetary policy in their respective regions, providing payment services, and serving as a lender of last resort to banks. Federal Open Market Committee, FOMC. The FOMC is responsible for setting monetary policy and consists of members of the Board of Governors and presidents of the Federal Reserve Banks. The Federal Reserve System is a complex organization that plays a critical role in managing the U.S. economy and maintaining financial stability. Its policies and actions can have a significant impact on financial markets and the economy as a whole. ECB system. The European Central Bank, ECB, is the central bank of the European Union, EU, and is responsible for conducting monetary policy for the euro area. It was established in 1998, and its headquarters are located in Frankfurt, Germany. The ECB's primary objective is to maintain price stability within the euro area. It does this by setting a target inflation rate of below, but close to, 2% over the medium term. In addition to its primary objective, the ECB also has a secondary objective to support economic growth and job creation. The ECB's key responsibilities include conducting monetary policy. The ECB is responsible for setting monetary policy for the euro area. This includes adjusting interest rates, managing the money supply, and conducting open market operations. Supervising and regulating banks. The ECB is responsible for supervising and regulating banks to ensure the safety and soundness of the banking system. Maintaining financial stability. The ECB plays a critical role in maintaining financial stability by monitoring and mitigating systemic risks within the euro area. Issuing and managing the euro. The ECB is responsible for issuing and managing the euro currency. The ECB is governed by several entities including the Governing Council. The Governing Council is the main decision-making body of the ECB, and is responsible for setting monetary policy. The Executive Board. The Executive Board is responsible for implementing the decisions of the Governing Council and managing the day-to-day operations of the ECB. The General Council. The General Council is responsible for guiding the ECB's policies during the transition period, when a country joins the euro area. The ECB works closely with other central banks and international organizations, such as the International Monetary Fund, IMF, and the Bank for International Settlements, BIS, to promote financial stability and economic growth. Movers. Market movers are factors that can cause significant price movements in financial markets, such as the stock market, forex market, and commodity markets. These factors can have a significant impact on trading decisions and can create opportunities for profit or loss. Some of the most common market movers include economic indicators. Economic indicators, such as gross domestic product, GDP, inflation, and employment data, can provide insight into the health of the economy and impact investor sentiment. Positive economic data can lead to increased buying activity, while negative data can lead to selling. Central bank policies. The policies and decisions of central banks, such as the Federal Reserve or the European Central Bank, can have a significant impact on financial markets. Interest rate decisions, changes in monetary policy, and other announcements can cause market volatility. Company earnings. The earnings reports of publicly traded companies can impact their stock prices and the broader market. Positive earnings reports can lead to increased demand for a company's stock, while negative reports can lead to selling. Geopolitical events. Geopolitical events, such as elections, wars, and natural disasters, can impact financial markets. These events can create uncertainty and volatility in markets, as investors try to assess the potential impact on the economy. Market sentiment. Market sentiment refers to the overall mood or attitude of investors toward a particular market or asset. Positive sentiment can lead to increased buying activity, while negative sentiment can lead to selling. It is important for traders to stay up to date on market movers and to incorporate them into their trading strategies. By monitoring these factors, traders can identify potential trading opportunities and manage risk effectively. Political events. Geopolitical events, such as elections, wars, and natural disasters, can have a significant impact on financial markets. These events can create uncertainty and volatility in markets, as investors try to assess the potential impact on the economy. Here are a few ways in which geopolitical events can affect markets. Risk perception. Geopolitical events can change the perception of risk in financial markets. For example, a military conflict between two countries can create uncertainty and increase the perceived risk of investing in those countries. Safe haven assets. During times of uncertainty, investors may seek out safe haven assets, such as gold or the US dollar, as a store of value. This can lead to increased demand for those assets and can impact their prices. Currency exchange rates. Geopolitical events can also impact currency exchange rates. For example, if there is uncertainty surrounding the outcome of an election, the currency of the country in question may weaken, as investors become more risk-averse. Commodity prices. Geopolitical events can also impact commodity prices. For example, if a natural disaster disrupts the supply of a particular commodity, such as oil or wheat, the price of that commodity may increase. Investor sentiment. Geopolitical events can also impact investor sentiment, which can in turn impact financial markets. For example, a terrorist attack or a major data breach can create negative sentiment, which can lead to increased selling activity. It is important for traders to stay up to date on geopolitical events and to monitor their potential impact on financial markets. By doing so, traders can identify potential trading opportunities and manage risk effectively. Sentiment. Market sentiment refers to the overall mood or attitude of investors toward a particular market or asset. It is the collective perception of market participants regarding the future performance of a market or asset. Market sentiment can be bullish, meaning that investors are optimistic and expect prices to rise, or bearish, meaning that investors are pessimistic and expect prices to fall. Market sentiment can affect trading in several ways. Trading decisions. Market sentiment can influence the decisions of traders and investors. For example, if market sentiment is bullish, traders may be more likely to buy stocks or other assets, while if market sentiment is bearish, they may be more likely to sell. Price movements. Market sentiment can impact price movements in financial markets. For example, if market sentiment is bullish, demand for stocks may increase, which can drive up prices. Conversely, if market sentiment is bearish, selling activity may increase, which can drive down prices. Volatility. Market sentiment can also impact market volatility. For example, if market sentiment is uncertain or negative, there may be more price fluctuations and increased volatility in financial markets. Risk management. Market sentiment can also impact risk management strategies. Traders may adjust their risk management strategies based on market sentiment, such as using stop-loss orders or other risk management tools to limit potential losses. It is important for traders to monitor market sentiment, and to incorporate it into their trading strategies. By doing so, traders can identify potential trading opportunities, manage risk effectively, and make more informed trading decisions. Market sentiment. There are several ways to track market sentiment in trading. News and social media. One way to track market sentiment is to monitor news and social media. News, stories and social media posts can provide insight into how investors and traders are feeling about a particular market or asset. For example, if there is a lot of positive news about a company, it may indicate that market sentiment is bullish. Technical analysis. Technical analysis can also provide insight into market sentiment. Chart patterns and technical indicators can provide clues about the direction of the market, and the sentiment of traders. Sentiment indicators. There are also sentiment indicators that are specifically designed to measure market sentiment. These indicators can provide a quantitative measure of market sentiment, which can be helpful in making trading decisions. Examples of sentiment indicators include the SIBO Volatility Index, VIX, which measures market volatility, and the American Association of Individual Investors, AAI, Sentiment Survey, which measures the sentiment of individual investors. Insider trading. Monitoring insider trading activity can also provide insight into market sentiment. If insiders are buying or selling a particular stock, It may indicate that they have a positive or negative outlook on the company. Market breadth indicators. Market breadth indicators measure the number of stocks that are advancing versus those that are declining. If there are more stocks advancing than declining, it may indicate that market sentiment is bullish, while if there are more declining stocks, it may indicate that market sentiment is bearish. By tracking market sentiment, traders can identify potential trading opportunities and manage risk effectively. However, it's important to remember that market sentiment is just one factor to consider when making trading decisions, and it should be used in conjunction with other tools and strategies. Sentiment, the Commitment of Traders, COT, Report. The Commitment of Traders, COT, Report is a weekly report published by the U.S. Commodity Futures Trading Commission, CFTC, that provides information on the positioning of various market participants in futures markets. The report shows the positions of commercial traders, non-commercial traders, such as hedge funds and other large speculators, and small traders. The COT report is important for traders because it provides insight into the behavior of these different groups of traders and can help identify potential market trends. For example, if non-commercial traders are increasing their long positions in a particular commodity, it may indicate that they are bullish on the commodity and that prices may rise in the future. The COT report includes data on a range of markets, including commodities, currencies, and stock index futures. The report is typically released on Fridays and covers data as of the previous Tuesday. Traders can access the report on the CFTC's website or through various financial data providers. It's important to note that while the COT report can be a useful tool for traders, it is not a guarantee of future market movements. Traders should use the report in conjunction with other tools and strategies to make informed trading decisions. Here is an example of a COT report for crude oil futures, as of September 7, 2021. Market, crude oil futures, NYMEX. Non-commercial positions. Long, 466,106, an increase of 12,678 from the previous week. Short, 178,891, a decrease of 5,802 from the previous week. Net, plus 287,215, an increase of 18,480 from the previous week. Commercial positions. Long, 507,876, a decrease of 2,941 from the previous week. Short, 764,646, a decrease of 10,534 from the previous week. Net, minus 256,770, an increase of 7,593 from the previous week. Small traders' positions. Long, 73,305, a decrease of 1,577 from the previous week. Short, 82,481, a decrease of 2,936 from the previous week. Net, minus 9,176, an increase of 1,359 from the previous week. In this example, the report shows the positions held by non-commercial traders, commercial traders, and small traders. It provides the number of long and short contracts held by each group, as well as the net positions, long contracts minus short contracts. The report also shows how the positions have changed from the previous week. Traders and analysts can use this information to gain insight into market sentiment and identify potential trends. For example, in this report, non-commercial traders increased their long positions and decreased their short positions, indicating a bullish sentiment towards crude oil futures. Here is another example of traders report using currencies, specifically the euro, EUR, and the US dollar, USD, as of September 7, 2021. Market, Euro FX Futures, CME. Non-commercial positions. Long, 134,243, an increase of 1,266 from the previous week. Short, 82,548, a decrease of 2,045 from the previous week. Net, plus 51,695, an increase of 3,311 from the previous week. Commercial positions. Long, 156,753, an increase of 2,080 from the previous week. Short, 180,939, an increase of 4,298 from the previous week. Net, minus 24,186, a decrease of 2,218 from the previous week. Small traders' positions. Long, 36,559, an increase of 715 from the previous week. Short, 32,722, a decrease of 321 from the previous week. Net, plus 3,837, an increase of 1,036 from the previous week. Market, US Dollar Index Futures, ICE. Non-commercial positions. Long, 7,966, a decrease of 3,462 from the previous week. Short, 28,902, a decrease of 1,983 from the previous week. Net, minus 20,936, a decrease of 1,479 from the previous week. Commercial positions. Long, 25,856, an increase of 808 from the previous week. Short, 42,736, an increase of 3,237 from the previous week. Net, minus 16,880, a decrease of 2,429 from the previous week. Small traders' positions. Long, 11,535, a decrease of 2,449 from the previous week. Short, 5,152, a decrease of 1,407 from the previous week. Net, plus 6,383, a decrease of 1,042 from the previous week. In this example, the report shows the positions held by non-commercial traders, commercial traders, and small traders in both the euro and USD futures markets. It provides the number of long and short contracts held by each group, as well as the net positions, long contracts minus short contracts. The report also shows how the positions have changed from the previous week. Traders and analysts can use this information to gain insight into market sentiment and identify potential trends in the year and USD futures markets. For example, in this report, non-commercial traders decreased their long positions and decreased their short positions in the USD futures market, indicating a bearish sentiment towards the USD. On the other hand, non-commercial traders increased their long positions and decreased their short positions in the year futures market, indicating a bullish sentiment towards the year. The news. Trading the news involves taking advantage of market movements that occur in response to significant news events, such as economic releases, corporate earnings announcements, or geopolitical events. Here are some steps to consider when trading the news. Identify the news event. The first step in trading the news is to identify the event that you want to trade. This could be an economic release, such as a GDP report or a central bank interest rate decision, or a corporate earnings announcement. Monitor the news. Once you have identified the event, you will need to monitor the news closely. This can involve following news sources, such as financial news websites, or setting up news alerts that will notify you when the news is released. Analyze the news. Once the news is released, you will need to analyze it to determine how it may impact the market. For example, if a central bank announces an interest rate hike, it may be bullish for the currency of that country. On the other hand, if a company reports disappointing earnings, it may be bearish for its stock. Decide on a trading strategy. Based on your analysis, you will need to decide on a trading strategy. This could involve buying or selling a particular asset, or using options or other derivatives, to take advantage of the market movement. Manage risk. As with any trading strategy, it's important to manage risk when trading the news. This could involve setting stop-loss orders or using other risk management tools to limit potential losses. Execute the trade. Once you have decided on a strategy and managed your risk, you can execute the trade. Depending on your strategy, this may involve buying or selling a particular asset, or using options or other derivatives to take advantage of the market movement. It's important to remember that trading the news can be risky, as markets can be volatile in response to significant events. Traders should use caution, and consider their risk tolerance when trading the news. It's also important to use other tools and strategies in conjunction with news trading to make informed trading decisions. Here is an example of news trading. Let's say that the U.S. Bureau of Labor Statistics releases the Non-Farm Payroll, NFP, report, which measures the number of new jobs created in the U.S. economy. The report shows that the U.S. economy created 250,000 new jobs last month, which is significantly higher than the expected figure of 180,000 new jobs. A news trader who follows the NFP report may anticipate that this positive news will cause the US dollar to strengthen against other currencies. In response, the trader could take a long position in the USD by buying USD currency pairs, such as US dollar to euro or US dollar to Japanese yen. The trader may also choose to use a stop-loss order to limit potential losses if the market does not move as expected. Alternatively, the trader may set a profit target and close the position once that target is reached. If the market does indeed react as expected, the trader could potentially earn a profit from the short-term price movements that occur after the news release. However, it's important to note that news trading can be risky, as market reactions can be unpredictable and prices can move very quickly. News traders must be able to react quickly and have a solid understanding of the fundamental factors that drive financial markets. Correlations. Market correlations are the relationships between two or more markets and their tendency to move in the same or opposite directions. Correlations can be positive, markets move in the same direction, or negative, markets move in opposite directions. Market correlations can impact trading in several ways. Diversification. Correlations can help traders diversify their portfolios by identifying markets that are not highly correlated with each other. This can help reduce risk and improve overall portfolio performance. Risk management. Correlations can help traders manage risk by identifying markets that are highly correlated. When markets are highly correlated, traders may need to adjust their positions or use risk management tools to limit potential losses. Trading strategies. Correlations can be used to develop trading strategies. For example, if two markets are highly positively correlated, a trader may look for opportunities to trade the spread between the two markets. Volatility. Correlations can impact market volatility. When markets are highly correlated, volatility may increase as traders react to news and events that impact both markets. Market sentiment. Correlations can also impact market sentiment. When two markets are highly correlated, news and events that impact one market may also impact the other market, leading to changes in market sentiment. Overall, understanding market correlations is an important aspect of trading. By identifying correlations between markets, traders can develop more effective trading strategies, manage risk, and improve portfolio performance. Examples of market correlations. Here are some examples of market correlations. Stock market and bond market. Historically, the stock market and bond market have had a negative correlation. This means that when the stock market goes up, the bond market tends to go down, and vice versa. This is because investors tend to move their money from stocks to bonds when they are seeking safety and stability. Gold and the US dollar. Gold and the US dollar have an inverse correlation, meaning that when the value of the US dollar goes up, the price of gold tends to go down, and vice versa. This is because gold is priced in US dollars, so a stronger dollar makes gold more expensive for buyers who use other currencies. Oil and the Canadian dollar. Canada is a major exporter of oil, so the Canadian dollar tends to have a positive correlation with the price of oil. When oil prices rise, the Canadian dollar tends to appreciate, and when oil prices fall, the Canadian dollar tends to depreciate. Emerging markets and commodities. Emerging market economies tend to be heavily dependent on commodity exports, so there is often a positive correlation between emerging market stocks and commodity prices. When commodity prices rise, emerging market stocks tend to perform well, and when commodity prices fall, emerging market stocks tend to underperform. Technology stocks and growth stocks. Technology stocks and growth stocks tend to have a positive correlation, as both are often associated with high growth potential. When the technology sector is performing well, growth stocks tend to perform well, and vice versa. It's important to note that correlations between markets can change over time, and may not always be consistent. It's also important to use other tools and strategies in conjunction with market correlations to make informed trading decisions. Analysis. The top-down approach is a method of analyzing financial markets and individual securities that starts with an examination of the broader economic and market environment before moving on to individual companies or assets. This approach is often used in fundamental analysis, which seeks to evaluate the intrinsic value of an asset by examining economic, financial, and other qualitative and quantitative factors. The top-down approach typically involves the following steps. Economic analysis. The first step in the top-down approach is to analyze the overall economic environment, including factors such as GDP growth, inflation, interest rates, and government policies. This analysis can help investors identify macroeconomic trends and potential investment opportunities or risks. Industry analysis. The next step is to examine specific industries and sectors of the economy to identify areas of potential growth or decline. This analysis can help investors identify which industries or sectors are likely to outperform or underperform based on the broader economic environment. Company analysis. Once potential industries or sectors have been identified, investors can then examine individual companies within those sectors to determine which companies have strong fundamentals and are likely to outperform their peers. This analysis typically includes factors such as revenue growth, profit margins, management quality, and competitive position. Asset analysis. Finally, investors can analyze individual assets or securities within a company, such as stocks or bonds, to determine whether they are undervalued or overvalued based on the company's fundamentals and the broader economic and market environment. By following this top-down approach, investors can gain a more holistic understanding of the market environment and make more informed investment decisions based on a thorough analysis of the economic, industry, company, and asset-specific factors that are most relevant to their investment goals and risk tolerance. Analysis. Ratio analysis is a tool used in financial analysis to evaluate a company's financial performance by comparing different financial metrics. Ratios are typically calculated by dividing one financial metric by another, which provides insight into how efficiently a company is utilizing its resources, managing its finances, and generating profits. Here are some examples of common ratios and their meanings. Return on equity, ROE. ROE is a ratio that measures a company's profitability relative to its shareholders' equity. It is calculated by dividing net income by shareholder equity. A high ROE suggests that a company is effectively utilizing its shareholders' equity to generate profits. Price-to-earnings ratio, P/E ratio. The P/E ratio is a valuation ratio that compares a company's current stock price to its earnings per share, EPS. A high P/E ratio suggests that the market has high expectations for the company's future earnings growth. Debt-to-equity ratio. The debt-to-equity ratio measures a company's leverage by comparing its total liabilities to its shareholder equity. A high debt-to-equity ratio indicates that a company has a significant amount of debt relative to its equity, which can increase its financial risk. Current ratio. The current ratio is a liquidity ratio that measures a company's ability to meet its short-term obligations. It is calculated by dividing a company's current assets by its current liabilities. A high current ratio suggests that a company has sufficient liquidity to meet its short-term obligations. Gross margin. The gross margin is a profitability ratio that measures the percentage of sales that exceeds the cost of goods sold. It is calculated by dividing gross profit by revenue. A high gross margin suggests that a company is generating strong profits from its core operations. These are just a few examples of common ratios used in financial analysis. By comparing and analyzing these ratios over time, investors can gain insight into a company's financial health and performance, and make more informed investment decisions. Here is an example of how ratio analysis is performed using a hypothetical company. Let's say we want to perform ratio analysis on ABC Corporation, a publicly traded company in the technology sector. We can start by looking at its financial statements, including the income statement and balance sheet, and use the data to calculate various ratios. Here are some key financial metrics for ABC Corporation. Net income, $10 million shareholder equity, $50 million earnings per share, $2.50 stock price, $50 per share revenue, $100 million cost of goods sold, $60 million total liabilities, $30 million current assets, $40 million current liabilities, $20 million gross profit, $40 million. Using this data, we can calculate the following ratios. Return on equity, ROE, equals net income, shareholder equity ROE equals $10 million, $50 million ROE equals 0.2 or 20%. Price to earnings ratio, PE ratio, equals stock price, earnings per share P ratio equals $50, $2.50 P ratio equals 20. Debt to equity ratio equals total liabilities, shareholder equity debt to equity ratio equals $30 million, $50 million debt to equity ratio equals 0.6 or 60%. Current ratio equals current assets, current liabilities current ratio equals $40 million, $20 million current ratio equals 2. Gross margin equals gross profit. Revenue gross margin equals $40 million, $100 million gross margin equals 0.4 or 40%. By analyzing these ratios, we can gain insights into ABC Corporation's financial health and performance. For example, the 20% row suggests that the company is generating a healthy return on equity for its shareholders. The P ratio of 20 suggests that the market has high expectations for the company's future earnings growth. The debt-to-equity ratio of 60% indicates that the company has a significant amount of debt relative to its equity, which may increase its financial risk. The current ratio of 2 suggests that the company has sufficient liquidity to meet its short-term obligations. The gross margin of 40% indicates that the company is generating strong profits from its core operations. Overall, ratio analysis provides a useful tool for investors and analysts to evaluate a company's financial health and performance and make more informed investment decisions. Analysis versus fundamental analysis. Both technical and fundamental analysis have their own advantages and disadvantages, and which one is better ultimately depends on the individual investor's preferences, investment goals, and risk tolerance. Technical analysis is focused on analyzing market data such as price and volume trends to identify patterns and make investment decisions. This approach assumes that all relevant information is already reflected in the price of a security, and that by analyzing historical price movements, an investor can predict future price movements. Technical analysis can be useful for short-term trading strategies and identifying entry and exit points for investments. Fundamental analysis, on the other hand, involves analyzing a company's financial and economic fundamentals such as earnings, revenue growth, and management quality to evaluate its intrinsic value and make investment decisions. This approach assumes that a company's true value is reflected in its fundamentals, and that by analyzing these factors, an investor can identify undervalued or overvalued stocks. Fundamental analysis can be useful for long-term investing strategies and for identifying companies with growth potential. Ultimately, investors should consider using both technical and fundamental analysis to gain a more comprehensive understanding of the markets and individual securities. It's also important to note that neither approach can guarantee investment success, as the markets are inherently unpredictable and subject to volatility. This section file covers the importance of having a trading plan. It explains that having a trading plan is important for several reasons, including clarity of objectives, risk management, discipline, consistency, and improvement. The section goes into detail about each of these reasons and how a trading plan can help traders achieve success in their trading. For example, it explains that a trading plan can help traders manage their emotions by avoiding impulsive and irrational trading decisions. It also provides tips on how to develop a systematic approach to trading. The following points are discussed. 1. Clarity of objectives. A trading plan helps traders to define their goals and objectives, which is critical for success in trading. It helps traders to have a clear understanding of what they want to achieve and how they plan to achieve it. 2. Risk management. A trading plan helps traders to manage risk by setting stop-loss orders and identifying potential risks in the market. It also helps traders to manage their emotions, as emotions can often lead to impulsive and irrational trading decisions. 3. Discipline. A trading plan helps traders to remain disciplined and focused on their objectives. It helps traders to avoid the temptation of chasing profits or making impulsive trades that could lead to losses. 4. Consistency. A trading plan helps traders to be consistent in their trading approach. It helps traders to develop a systematic approach to trading, which can be measured and evaluated over time. 5. Improvement. A trading plan helps traders to evaluate their performance and identify areas for improvement. It allows traders to learn from their mistakes and make changes to their approach as needed. Overall, this section is a helpful guide for traders who want to improve their trading performance by creating a solid trading plan. Purpose of a trading plan. Having a trading plan is important for several reasons. Clarity of objectives. A trading plan helps traders to define their goals and objectives, which is critical for success in trading. It helps traders to have a clear understanding of what they want to achieve and how they plan to achieve it. Risk management. A trading plan helps traders to manage risk by setting stop-loss orders and identifying potential risks in the market. It also helps traders to manage their emotions, as emotions can often lead to impulsive and irrational trading decisions. Discipline. A trading plan helps traders to remain disciplined and focused on their objectives. It helps traders to avoid the temptation of chasing profits or making impulsive trades that could lead to losses. Consistency. A trading plan helps traders to be consistent in their trading approach. It helps traders to develop a systematic approach to trading, which can be measured and evaluated over time. Improvement. A trading plan helps traders to evaluate their performance and identify areas for improvement. It allows traders to learn from their mistakes and make changes to their approach as needed. Overall, having a trading plan is essential for success in trading. It helps traders to remain focused, disciplined, and consistent in their approach, which is critical for long-term success in the markets. Example of a trading plan. Here's an example of a trading plan. Trading objectives. Goal: to achieve an average return of 10% per year. Time horizon: long-term trading, over 12 months. Risk tolerance, medium. Trading strategy. Trading style: swing trading. Markets: equities and exchange-traded funds, ETFs. Analysis: technical analysis, and market trends. Trading signals: moving averages, chart patterns, and support/resistance levels. Position sizing: risk no more than 1% of total account equity on any one trade. Exit strategy: stop-loss orders and trailing stop-loss orders. Trading rules: no more than 3 open positions at any one time. Risk management: risk/reward ratio. Aim for a minimum of 1 to 2 risk/reward ratio on each trade. Stop-loss orders: place stop-loss orders on all trades to limit losses. Account monitoring: monitor account balance daily to ensure adequate margin coverage. Diversification: diversify portfolio across different sectors and asset classes. Trading psychology: emotions. Manage emotions by following a disciplined trading plan. Mindset: focus on long-term goals and remain patient. Journaling: keep a trading journal to track performance and evaluate mistakes. Trading resources. Trading platform: use a reliable trading platform with access to technical analysis tools and real-time market data. Education: continuously educate oneself on market trends and trading strategies. News and research: stay up to date with financial news and research reports. Overall, a trading plan should be customized to fit the individual trader's preferences and goals. It should be reviewed and adjusted regularly to reflect changes in the market and the trader's performance. Journal. Keeping a trading journal is an essential part of a trader's routine. Here are some steps to follow when journaling trades. Record the trade details. Start by recording the basic information about the trade, including the date, time, asset, entry price, exit price, position size, and type of order, market or limit. Record the reason for the trade. Write down the reason for taking the trade, including the analysis and strategy used to enter the trade. Record the emotions. Record the emotions that were felt during the trade, such as fear, greed, or excitement. This can help traders identify patterns in their emotional responses to different market situations. Record the outcome. Record the outcome of the trade, including the profit or loss, the reasons for the outcome, and what was learned from the trade. Analyze the trade. Analyze the trade by reviewing the market conditions at the time of entry and exit, the indicators used, and any other factors that may have influenced the trade. Identify patterns. Look for patterns in the trades, such as winning and losing streaks, and identify areas for improvement. Set goals. Set goals for future trades based on the analysis of the past trades. Review the journal regularly. Review the journal regularly to evaluate performance and make adjustments to the trading plan. By following these steps, traders can use their trading journal as a tool for self-improvement, risk management, and decision-making. Here's an example of a trading journal. Date, March 11, 2023. Trading instrument, Euro to US dollar. Trading time, 9 a.m. to 10 a.m. EST. Position, long. Entry price, 1.2200. Exit price, 1.2250. Stop loss, 1.2150. Profit target, 1.2300. Profit/loss, plus 50 pips, plus $500. Reason for trade. Identified bullish trend on daily chart and entered on pullback to support level. Analysis. Trade was successful due to a combination of technical analysis and market fundamentals. The bullish trend was confirmed on the daily chart, and the entry point was chosen based on a pullback to a key support level. The stop loss was set at a reasonable level to limit risk, and the profit target was set at a reasonable level to take profit while allowing for further upward movement. Lessons learned. The trade followed my trading plan, and was executed according to my strategy. However, I could have taken profits at an earlier point to lock in gains and reduce risk. In the future, I will consider taking partial profits at a predetermined level to manage risk and maximize gains. Overall, keeping a detailed trading journal helps traders analyze their performance and make adjustments to their trading strategy over time. Orders. Putting a stop-loss order is necessary because it helps traders to manage their risk by limiting their potential losses on a trade. A stop-loss order is a type of order that instructs the broker to sell the security if it reaches a specified price level. This price level is called the stop-loss level, and it is set by the trader at the time of placing the trade. The purpose of a stop-loss order is to protect the trader from large losses in case the trade moves against them. By setting a stop-loss order, the trader can limit their potential loss to a predetermined amount, which can be calculated based on their risk tolerance and position size. Without a stop-loss order, a trader may be exposed to unlimited losses if the trade moves against them. In addition, the absence of a stop-loss order may also lead to emotional trading decisions, as the trader may hold on to a losing trade in the hope that the price will eventually recover. Overall, a stop-loss order is a crucial risk management tool that helps traders to limit their potential losses and avoid emotional trading decisions. It is important for traders to set stop-loss orders based on their trading strategy and risk tolerance to ensure that their trading plan is effective in achieving their trading goals. Here's an example of a stop-loss order. Let's say you bought 100 shares of ABC Company at $50 per share, and you want to limit your potential losses if the price starts to drop. You might place a stop-loss order at $45 per share. If the price of ABC Company drops to $45 per share, your stop-loss order will be triggered and your broker will automatically sell your shares to limit your losses. If the price doesn't drop to $45 per share, the stop-loss order will remain in place until it is either triggered or cancelled. Stop-loss orders can be an effective way to manage risk in trading, as they allow traders to limit their losses and protect their capital. However, it's important to note that stop-loss orders are not guaranteed to execute at the exact price specified, particularly in fast-moving markets or during times of extreme volatility. The reward ratio. The risk-to-reward ratio, RRR, is a measure of the potential profit versus the potential loss of a trade. It is calculated by dividing the amount of potential profit by the amount of potential loss. A higher RRR indicates that the potential reward of the trade is greater than its potential risk. Managing the RRR is an important part of a trader's risk management strategy. Here are some tips on how to manage the RRR. Determine the RRR before entering a trade. Before entering a trade, calculate the RRR to determine whether the potential profit is worth the potential risk. A good rule of thumb is to aim for an RRR of at least 1 to 2, meaning the potential reward should be twice the size of the potential risk. Adjust position size to manage RRR. One way to manage the RRR is to adjust the position size based on the RRR. For example, if the RRR is less than 1 to 2, the trader may reduce their position size to limit their potential loss. Move stop loss to manage RRR. Another way to manage the RRR is to move the stop-loss order to lock in profits as the trade moves in the trader's favor. This can help to increase the potential reward and reduce the potential risk of the trade. Evaluate the RRR after the trade. After the trade is closed, evaluate the RRR to determine whether the RRR was effective in managing risk. If the RRR was not effective, the trader may need to adjust their trading plan to improve their risk management strategy. Overall, managing the RRR is essential for effective risk management in trading. Traders should aim to maintain a consistent RRR and adjust their position size or stop-loss order as necessary to achieve their desired risk-reward ratio. Sizing. Position sizing is the process of determining the appropriate amount of capital to allocate to a particular trade or investment. It involves deciding how many shares or contracts to buy or sell based on the size of the trading account, risk tolerance, and the characteristics of the trade, such as the expected return, the potential risk, and the volatility of the asset. Position sizing is important in trading because it can help manage risk and maximize potential profits. By carefully sizing positions, traders can limit their exposure to losses if the trade doesn't go as planned. For example, if a trader risks too much on a single trade, they may lose a significant portion of their trading account if the trade turns against them. On the other hand, if they risk too little, they may not be able to capitalize on profitable opportunities. Position sizing can also help traders manage their emotions and avoid making impulsive decisions. When traders know how much they can afford to risk on a trade, they are less likely to panic and exit a position prematurely or hold onto a losing trade for too long. Overall, position sizing is an essential component of a trader's risk management strategy. It helps traders balance risk and reward, manage their emotions, and increase their chances of long-term trading success. Let's say you have a trading account with $10,000 and you want to trade the euro to US dollar currency pair. You have identified a potential trade with a stop loss of 50 pips and a profit target of 100 pips. To determine the appropriate position size, you can use the following formula. Position size equals risk amount, trade risk. Where risk amount is the amount you are willing to risk on the trade and trade risk is the amount you could lose if the trade goes against you. Let's assume that you are willing to risk 1% of your account on this trade, or $100. The trade risk is calculated as trade risk equals stop loss in pips, x, pip value, x, number of lots. Assuming your account is denominated in USD, the pip value for euro to US dollar is $10 for a standard lot, 100,000 units, and you have a maximum risk of $100. The trade risk can be calculated as follows. Trade risk equals 50 pips, x, $10/pip, x, number of lots, equals $5 x number of lots. Now, you can solve for the position size. Position size equals $100, $5 equals 20 lots. Therefore, to risk 1% of your account on this trade, you would need to trade 20 standard lots of euro to US dollar. Note that this is just an example, and the actual position size will depend on the trader's risk tolerance, account size, and trading strategy. Of a risk management plan. Here are some examples of a risk management plan for traders. Set a stop-loss order. Traders can use stop-loss orders to limit their potential losses on a trade. The stop-loss order is placed at a predetermined price level and is designed to close the trade if the price moves against the trader. Use position sizing. Position sizing refers to the number of shares or contracts traded in a single trade. Traders can use position sizing to control the amount of risk they are taking on each trade. Diversify trades. Traders can diversify their trades by trading multiple assets, such as stocks, options and futures. This can help to reduce the risk of any single trade or asset. Limit leverage. Leverage can amplify gains and losses, and traders should be aware of the risks associated with using leverage. It is important to limit leverage to a level that is appropriate for the trader's risk tolerance. Monitor news and events. news and events can affect the market and the traders' positions. Traders should stay informed about the latest news and events and be prepared to adjust their positions if necessary. Review and evaluate trades. Traders should review and evaluate their trades regularly to identify areas for improvement. This can help to refine the trader's risk management strategy and improve their overall performance. Overall, a risk management plan should be tailored to the trader's individual risk tolerance, trading strategy, and financial goals. By implementing a comprehensive risk management plan, traders can limit their potential losses and achieve more consistent returns over time. This section highlights the huge importance of psychology in trading. Trading psychology refers to the emotional and mental state of a trader while engaging in trading activities. It is the study of how human emotions and behaviors affect the decision-making process in trading, and how to manage those emotions to make more rational and profitable decisions. Trading psychology is important because emotions can have a significant impact on trading performance. For example, fear and greed can lead to impulsive decision-making, causing traders to take on too much risk or exit positions too early. On the other hand, overconfidence can lead traders to take on too much risk, leading to losses. Managing trading psychology involves several key factors, including developing a trading plan. Having a well-defined trading plan can help traders avoid making impulsive decisions based on emotions. Setting realistic expectations. It is important to have realistic expectations for trading performance and to avoid getting caught up in short-term wins or losses. Practicing discipline. Maintaining discipline in following a trading plan and sticking to risk management strategies can help reduce emotional reactions to market movements. Practicing self-awareness. Traders should be aware of their own emotions and behaviors and take steps to manage them when they start to affect trading decisions. Seeking support. Traders can benefit from having a support system of other traders or professionals to help manage emotional reactions to market movements. Overall, trading psychology is a critical aspect of successful trading. By managing emotions and behaviors, traders can make more rational and profitable decisions and achieve their trading objectives over the long term. 4. Murphy's Law is a popular adage that states, anything that can go wrong, will go wrong. The law implies that if something can happen, there is a high likelihood that it will happen. This means that even if you think you have planned for every possible scenario, there is still a chance that something unexpected will occur. When it comes to trading, Murphy's Law is particularly relevant because the markets are inherently unpredictable, and unexpected events can happen at any time. Traders can use the concept of Murphy's Law to remind themselves that they should always be prepared for the unexpected. For example, a trader might think they have identified a solid trading opportunity and placed a trade with a well-planned stop loss. However, unexpected news can hit the markets, causing prices to move against their position and trigger their stop loss. In this case, the trader would have experienced the reality of Murphy's Law, and learned the importance of being prepared for unexpected events. Overall, Murphy's Law serves as a reminder that traders should always be prepared for the unexpected and have a plan in place to manage risks and potential losses. Of large numbers. The law of large numbers is a mathematical concept that describes the tendency of a large sample size to have an average value that is close to the true value. In simpler terms, the more times an event occurs, the closer the actual outcome will be to the expected outcome. This law is particularly relevant in statistics, probability theory, and other fields where large sample sizes are involved. In trading, the law of large numbers can be used to understand the importance of having a trading strategy that is based on probabilities. This means that traders should focus on making trades that have a high probability of success over the long term. By making a large number of trades based on a well-defined trading plan, traders can increase their chances of achieving their desired outcome. For example, suppose a trader has a trading strategy that is based on technical analysis, and has a win rate of 60%. This means that out of 100 trades, they can expect to win 60 and lose 40. However, this win rate is not guaranteed for every 100 trades, as there will be variations in the outcome of individual trades. Nevertheless, as the trader continues to execute trades based on their strategy over a large number of trades, the law of large numbers suggests that the overall win rate will converge to the expected 60%. Let's have another example. Let's say that an investor decides to invest in a diversified portfolio of stocks in the S&P 500. They invest $10,000 and hold the portfolio for 1 year. At the end of the year, their returns are 10%. Now let's say that the investor decides to make the same investment in the S&P 500 every year for the next 10 years. Each year, they hold the portfolio for 1 year and earn a return. Over the 10 years, the investor's returns will fluctuate, but as they make more investments, the law of large numbers suggests that their average returns will approach the expected returns of the market. For example, if the expected return of the S&P 500 is 8%, the investor's average returns over the 10 years may converge to around 8%, even if some individual years had returns higher or lower than 8%. This is because the more investments the investor makes, the more likely they are to experience the full range of returns of the market, and the less likely they are to be affected by any 1 year's return. In other words, the law of large numbers suggests that as the sample size, number of investments, increases, the average returns will approach the expected returns. Therefore, traders can use the law of large numbers to develop a trading plan that has a high probability of success over a large number of trades, while also managing their risks and losses. By being disciplined and consistent in their approach, traders can increase their chances of success over the long term. Expectations. Having rational expectations when trading is essential because it helps traders make informed decisions based on realistic goals and outcomes. Rational expectations refer to the idea that traders should base their predictions of future price movements on all available information and factors that may affect the market. When traders have irrational expectations, they may make decisions based on emotions or biases rather than facts and analysis. This can lead to poor trading decisions, such as holding on to losing positions for too long or taking excessive risks in the hopes of achieving unrealistic gains. On the other hand, when traders have rational expectations, they are more likely to make informed decisions that are based on a realistic assessment of the market. This can lead to better risk management, improved trading strategies, and ultimately, more consistent trading results over the long term. In addition, Having rational expectations can help traders avoid the trap of overconfidence, which can lead to excessive risk-taking and losses. By maintaining a realistic and objective view of the market, traders can avoid making decisions that are driven by emotions or biases. Overall, having rational expectations when trading is essential because it helps traders make informed decisions that are based on a realistic assessment of the market. By focusing on objective analysis and avoiding emotional biases, traders can improve their chances of success over the long term. To have rational expectations, a trader must look at historical numbers. Here are some examples. US stock market, S&P 500 index. 2022, plus 27.51%. 2021, plus 28.71%. 2020, plus 16.26%. 2019, plus 31.49%. 2018, minus 4.38%. 2017, plus 21.83%. International Developed Stock Market, MSCI EAFE Index. 2022, plus 12.22%. 2021, plus 10.90%. 2020, plus 7.82%. 2019, plus 22.01%. 2018, minus 13.79%. 2017, plus 25.03%. Emerging Markets Stock Market, MSCI Emerging Markets Index. 2022, plus 4.18%. 2021, plus 2.88%. 2020, plus 18.31%. 2019, plus 18.42%. 2018, minus 14.58%. 2017, plus 34.43%. 4. US Bond Market, Bloomberg Barclays US Aggregate Bond Index. 2022, minus 1.55%. 2021, plus 6.77%. 2020, plus 7.51%. 2019, plus 8.72%. 2018, plus 0.01%. 2017, plus 3.54%. Please note that there are many other financial markets and asset classes, and their returns can vary widely depending on the specific investment and time period. Additionally, returns can be affected by factors such as inflation, currency exchange rates, and geopolitical events. With successive losses. Dealing with successive losses in trading can be a challenging and emotionally draining experience. However, it is an inevitable part of trading, and traders must learn how to manage their emotions and make rational decisions to avoid further losses. Here are some tips for dealing with successive losses in trading. Analyze your trading strategy. Take a step back and analyze your trading strategy. Review your trading plan, and evaluate whether it is still viable. Look for any weaknesses or flaws in your strategy and make the necessary adjustments. Stick to your trading plan. If you have a well-defined trading plan, stick to it. Avoid making impulsive decisions based on emotions or biases. Manage your risk. Make sure you have a risk management plan in place to limit your losses. This may involve setting stop-loss orders, reducing your position size, or taking a break from trading altogether. Keep a trading journal. Keep a record of your trades and review them regularly. Analyze your mistakes and learn from them. This can help you avoid making the same mistakes in the future. Take a break. If you are feeling overwhelmed or emotional after successive losses, take a break from trading. Step away from the markets for a few days or weeks and focus on other things. This can help you regain a clear perspective and avoid making further emotional decisions. Seek support. Talk to other traders or seek the guidance of a trading mentor or coach. Sometimes, just talking to someone who understands the challenges of trading can be helpful. In summary, dealing with successive losses in trading requires a disciplined and rational approach. By analyzing your strategy, managing your risk, and keeping a trading journal, you can learn from your mistakes and improve your trading over the long term. With fear. Fear is a powerful emotion that can have a significant impact on our decision-making process. When we experience fear, our brains release stress hormones such as cortisol and adrenaline, which trigger the fight or flight response. This response is a primitive survival mechanism that prepares our bodies to either confront a threat or flee from it. In the context of decision-making, fear can lead to several cognitive biases that can affect our judgment and decision-making process. Here are a few examples. 1. Loss aversion bias. Fear of loss can cause us to be overly cautious and avoid taking risks, even when the potential gains may outweigh the potential losses. This can lead to missed opportunities and suboptimal decision-making. 2. Confirmation bias. Fear can cause us to seek out information that confirms our existing beliefs and ignore information that contradicts them. This can lead to narrow-minded decision-making and prevent us from considering alternative viewpoints. 3. Overreaction bias. Fear can cause us to overreact to perceived threats and make decisions that are overly cautious or extreme. This can lead to unnecessary expenses, missed opportunities, and poor outcomes. 4. Decision paralysis. Fear can also cause us to become indecisive and avoid making decisions altogether. This can lead to missed opportunities and prevent us from taking action to address problems or pursue opportunities. Overall, fear can have a powerful impact on our decision-making process. It's important to recognize when fear is influencing our decisions and take steps to manage it. This can involve seeking out additional information, seeking out advice from others, or taking time to reflect on our decisions before acting on them. Dealing with fear in trading is crucial for traders to maintain a calm and objective mindset, and make rational decisions. Here are some tips for dealing with fear in trading. Identify the source of your fear. The first step to dealing with fear is to identify the source of it. Fear can arise from different factors such as a lack of confidence in your trading plan, fear of losing money, or fear of missing out on potential gains. Once you identify the source of your fear, you can take steps to address it. Stick to your trading plan. Having a well-defined trading plan and sticking to it can help alleviate fear. If you have a trading plan that is based on sound analysis and risk management, you can take trades with confidence, knowing that you have a plan in place to manage your risk. Manage your risk. Implementing proper risk management techniques can help reduce the impact of losses on your trading account. This can include setting stop-loss orders or reducing your position size when the market is volatile. Use positive self-talk. Use positive self-talk to reinforce your confidence in your trading plan. Tell yourself that you have done your analysis, and you are taking calculated risks based on your plan. Focus on the process, not the outcome. Instead of focusing on the outcome of each trade, focus on the process. That is, focus on following your trading plan, managing your risk, and making rational decisions based on market analysis. Take breaks. If you find yourself overwhelmed with fear or anxiety, take a break from trading. Step away from the markets and focus on other things, such as exercise or relaxation techniques, to help calm your mind. In summary, dealing with fear in trading requires a disciplined and rational approach. By identifying the source of your fear, sticking to your trading plan, managing your risk, using positive self-talk, focusing on the process, and taking breaks, you can maintain a calm and objective mindset, and make rational trading decisions. With greed. Greed is another powerful emotion that can have a significant impact on our decision-making process. When we experience greed, we are driven by a desire for more wealth, status, or power. This desire can lead to several cognitive biases that can affect our judgment and decision-making process. Here are a few examples. 1. Overconfidence bias. Greed can cause us to be overly confident in our abilities and make decisions that are overly optimistic or risky. This can lead to poor outcomes and financial losses. 2. Anchoring bias. Greed can cause us to become fixated on a specific outcome or goal, which can bias our judgment and prevent us from considering alternative options. This can lead to missed opportunities and poor decision-making. 3. Confirmation bias. Greed can cause us to seek out information that confirms our beliefs about the potential benefits of a decision, while ignoring information that contradicts those beliefs. This can lead to poor decision-making and missed opportunities. 4. Short-term thinking. Greed can cause us to focus on short-term gains, while ignoring the long-term consequences of our decisions. This can lead to poor outcomes and financial losses in the long run. Overall, greed can have a significant impact on our decision-making process, leading us to make decisions that are overly optimistic, biased, or short-sighted. It's important to recognize when greed is influencing our decisions and take steps to manage it. This can involve seeking out advice from others, taking time to reflect on our decisions, or setting clear goals and priorities to guide our decision-making. Dealing with greed in trading is essential because it can lead to irrational decisions and ultimately, losses. Here are some tips for dealing with greed when trading. Set realistic goals. Setting realistic trading goals can help you avoid the trap of greed. Instead of focusing on making large profits quickly, focus on consistent gains over the long term. Implement proper risk management. Proper risk management is essential to prevent losses from excessive greed. Implementing risk management strategies, such as setting stop-loss orders and reducing position sizes, can help you limit your losses. Stick to your trading plan. Stick to your trading plan and avoid deviating from it due to greed. If you have a well-defined trading plan, it can help you stay focused on your objectives and avoid making impulsive decisions. Take profits. Taking profits can help you avoid succumbing to greed. If you have reached your profit targets, close the trade and take the profit. Don't wait for more gains, as the market may reverse and result in losses. Keep a trading journal. Keeping a trading journal can help you analyze your trading behavior and identify any patterns of greed. This can help you take steps to address it. Learn from your mistakes. If you succumb to greed and make a loss, analyze your behavior and learn from your mistakes. This can help you avoid making the same mistakes in the future. In summary, dealing with greed in trading requires a disciplined and rational approach. By setting realistic goals, implementing proper risk management, sticking to your trading plan, taking profits, keeping a trading journal, and learning from your mistakes, you can avoid making impulsive decisions based on greed and improve your trading over the long term. Mindfulness is the practice of being present and fully engaged in the moment, without judgment. It involves being aware of your thoughts, feelings, and physical sensations and focusing your attention on the present moment. Mindfulness is essential for traders because it helps them maintain a calm and focused mindset, which is critical for making rational trading decisions. Here are some reasons why mindfulness is important for traders. Reduces stress and anxiety. Trading can be stressful and anxiety-inducing, especially during times of high volatility. Practicing mindfulness can help traders reduce stress and anxiety and stay calm and focused in the face of market uncertainty. Improves decision-making. Mindfulness can help traders make better decisions by improving their ability to focus and concentrate. By being fully present in the moment, traders can avoid distractions and make more rational decisions based on market analysis. Enhances self-awareness. Mindfulness helps traders develop greater self-awareness by becoming more attuned to their thoughts, emotions, and physical sensations. This can help traders identify and manage negative emotions that can interfere with their trading performance. Boosts resilience. Mindfulness can help traders develop greater resilience by enabling them to bounce back from losses and setbacks more quickly. By staying present and focused, traders can learn from their mistakes and make adjustments to their trading strategies. Improves overall well-being. Practicing mindfulness can have positive effects on overall well-being, including improved sleep, reduced stress levels, and increased feelings of calm and relaxation. Here are a few practices for mindfulness that you might find helpful. 1. Mindful breathing. Focus on your breath and pay attention to the sensation of the air moving in and out of your nostrils. You can do this for a few minutes at a time throughout the day or for a longer period of time during a formal meditation session. 2. Body scan. Lie down or sit comfortably and focus your attention on each part of your body, starting from your toes and moving up to your head. Pay attention to any sensations, tension or discomfort that you may feel, and allow yourself to relax and let go of any tension. 3. Mindful eating. Pay attention to the taste, texture, and aroma of your food. Take small bites and chew slowly, savoring each bite. This can help you appreciate the experience of eating and become more mindful of your hunger and fullness signals. 4. Walking meditation. Take a walk and focus your attention on the sensation of your feet touching the ground, the movement of your legs, and the scenery around you. This can help you become more present and grounded in the moment. 5. Mindful listening. Focus your attention on the sounds around you, without judgment or interpretation. Try to identify different sounds and notice their quality, pitch, and volume. 6. Gratitude practice. Take a few moments each day to reflect on the things you are grateful for. This can help you cultivate a sense of appreciation and contentment, and shift your focus from what you lack to what you have. Remember, mindfulness is a skill that requires practice, so don't worry if it doesn't feel natural at first. Start with short sessions and gradually increase the time as you become more comfortable with the practice. With regular practice, mindfulness can help you become more present, focused, and resilient in the face of stress and challenges. In summary, mindfulness is important for traders because it can help them reduce stress and anxiety, improve decision-making, enhance self-awareness, boost resilience, and improve overall well-being. By practicing mindfulness, traders can develop the mental discipline and focus needed to succeed in the markets over the long term. Of compounding. Compounding refers to the process of reinvesting profits or gains to generate additional earnings over time. In trading, the power of compounding is significant because it allows traders to earn interest on the interest they have already earned. For example, let's say you invest $10,000 in a stock that pays an annual interest rate of 10%. After 1 year, you would have earned $1,000 in interest, bringing your total investment value to $11,000. If you reinvested that $1,000 back into the same stock, the following year you would earn interest on $11,000, rather than just on your initial investment of $10,000. This compounding effect would continue each year, allowing your investment to grow exponentially. Compounding can also work in the opposite direction, meaning that if you have a loan or debt with compounding interest, your balance will grow faster over time, and you'll end up paying more in interest than if you had a loan with simple interest. Here are a few more examples that illustrate the power of compound interest. 1. Saving for retirement. Let's say you start saving $100 per month at age 25 and continue to save that amount until age 65, earning an average annual return of 7%. By the time you reach age 65, your initial investment of $24,000 would have grown to over $200,000 due to the power of compound interest. 2. Paying off debt. If you have credit card debt with an 18% interest rate, it can be difficult to make progress on paying it off. However, by making more than the minimum payment each month, you can reduce the amount of interest you pay and reduce the time it takes to pay off the debt. For example, if you have a $5,000 credit card balance and make a $200 payment each month, it will take over 4 years to pay off the debt and you'll pay over $2,600 in interest. However, by increasing your payment to $300 per month, you can pay off the debt in just over 2 years and save over $1,400 in interest. 3. Investing for the long term. Let's say you invest $10,000 in a stock that earns an average annual return of 10% over 30 years. If you leave the money invested and let the power of compound interest work its magic, your investment will grow to over $175,000. However, if you withdraw the earnings each year, your total return will be much lower. In summary, the power of interest compounding in trading can help traders grow their investments exponentially over time, allowing them to earn interest on the interest they have already earned. However, it's essential to keep in mind that compounding can work against you if you have a loan or debt with compounding interest. Wins and losses. Cluster wins and losses refer to a phenomenon in trading where a series of winning or losing trades occur in succession. This phenomenon can have a significant impact on traders, both psychologically and financially. When a trader experiences a cluster of winning trades, they may become overconfident and assume that their strategy or approach is infallible. This can lead to an increased appetite for risk, which can ultimately result in larger losses when the cluster of wins comes to an end. On the other hand, when a trader experiences a cluster of losses, they may become demoralized and question their approach or ability to trade. This can lead to emotional decision-making, such as revenge trading or taking on trades that are outside of their trading plan. This can result in even larger losses and further damage to their confidence. Traders should be aware of the potential impact of cluster wins and losses and have a plan in place to manage them. This plan should include risk management strategies such as position sizing, stop-loss orders, and taking breaks from trading to avoid making emotional decisions. It's important to remember that trading is a long-term game, and individual trades should not be viewed in isolation. A single win or loss is not indicative of a trader's overall success or failure. Instead, traders should focus on maintaining a consistent approach over time and managing risk to ensure that they can weather the ups and downs of trading, including clusters of wins and losses. In the Zone. Trading in the Zone is a book written by Mark Douglas that explores the psychology of trading in financial markets. The book is aimed at helping traders understand and manage their emotions and mindset, with the goal of improving their trading performance. The book argues that many traders fail to achieve success in the markets because they are not able to manage their emotions and stay disciplined in their trading approach. It emphasizes the importance of having a clear trading plan and following it consistently, as well as maintaining a mindset of objective analysis and risk management. The author explores several key concepts in the book, including the nature of probabilities in trading, the importance of having a positive mental attitude, and the role of intuition in decision-making. He also discusses common psychological traps that traders can fall into, such as fear, greed, and overconfidence, and provides strategies for overcoming these obstacles. Overall, Trading in the Zone provides a valuable framework for understanding the psychological challenges of trading and developing a mindset that is conducive to success in the markets. It emphasizes the importance of discipline, risk management, and emotional control, and provides practical advice and exercises for traders to develop these skills.